get a sense that these talks are falling farther and farther behind schedule. They really don't have any momentum at the moment. So we're basically at the halfway point of the 90-day reciprocal tariff pause, and we're still kind of spinning in their wheels, these two sides.
Brenda, do we have a better sense of what the United States ultimately wants to accomplish between revenue raising and leveling out the playing field when it comes to selling U.S. goods in Europe?
Yeah, it doesn't appear that the U.S. Is pushing for a quick deal with the EU. This could drag on for months and months. There are proposals out there that suggest that the Europeans should adopt a 90-month strategy rather than a 90-day strategy. So this is definitely slipping from a short-term goal into a medium or longer-term issue if the two sides want to avoid an all-out trade war.
Brendan, appreciate the update, sir. Thank you. We'll catch up with you hopefully next week. Brendan Murray there, who helps lead our trade coverage here at Bloomberg. If you want to upset the US, hold a call with Xi, which is what the Chancellor of Germany did just moments ago.
Yeah, coming out and President Xi Jinping saying that Germany and China have to cooperate further, in particular on automobiles. That cannot go well necessarily when it comes to U.S.-European discussions. I also wonder what the tenor of those discussions are from the German side, because they might get a whole host of Chinese vehicles dumped on them that are potentially lower cost and more fuel efficient. So how do they toggle with that at the same time that they're dealing with the United States?
Chinese overcapacity is an existential risk for so many of those German brands. That's the latest on the trade story. I want to turn back to financial markets and look at currencies. Tim Baker of Deutsche Bank warning this: U.S. fiscal risks may be worse for the dollar than for treasuries. Tim joins us now for more. Tim, welcome to the program, sir. This really strange mix so far this week where yields have risen and the dollar has weakened. And we saw a similar story in parts of April as well. Can we just start there, Tim? What do you think the big driver of that actually is?
Yes, I think we're seeing a shift from the past decade or so. Interest rates, relative interest rates have mattered so much for currencies, but we're looking at a bit of a regime shift now. After 10, 15 years of dollar strength and the rest of the world just loading up on dollar assets, whether it's equities, whether it's bonds, we're starting to see a realization, hey, there are other options around the world as other countries do fiscal policy. The market's getting worried about excessively easy fiscal policy in America. Valuations have got extended for currencies. So it's an environment where relative interest rates matter a little bit less, and valuations and where the flow of money is going to go matter a bit more. So that really underpins our shift to being bearish to the dollar these last few months.
Tim, I wonder how much of this is by design. Your colleague Peter Hooper put out a note that I thought was fascinating, highlighting how the dollar has appreciated by about 40% in the past 15 years, I should say, and that if you undid that 40% gain, you could probably even out the trade deficit. I mean, how much is that part of what people suspect is the plan?
Yeah, look, a little bit. I guess, I mean, the US administration says, look, we still have a strong dollar policy. I don't think that literally means as strong as it is now. It is very high. I just think it means they'd rather have it high rather than low. So, we're not heavily bearish and see the dollar getting to all-time lows or anything like that. I mean, how deliberate is it? I kind of take the administration at their word. They're focused on bond yields. They're focused on Main Street over Wall Street and all that stuff. That kind of makes sense to me. Would they kind of be happy with a bit of dollar weakness to go along with that, to rebalance trade a bit? Sure. I think it's a moderate kind of aim, maybe, just to get a bit of excessive expensiveness out of the dollar. But I think they're still pretty focused on keeping interest rates at a reasonable level and fostering that private sector growth. Now, whether they can do that, whether it can be achieved, that's a separate question. But I think that is their primary aim, and the dollar's not quite as important.
I felt this from Sebastian Page, as well as from you, Tim, which is there's a pretty big distinction between there is a loss of U.S. exceptionalism, that the dollar's reserve status is being undermined, and it was just overvalued. It just needs to lose a little bit, and other currencies need to gain. Those are two very different types of concepts. How do you draw the line between the two?
Well, I guess I'd say, I kind of think both are right. I guess I'd just say it's not a precise, easy binary to say, look, the dollar either has reserve status and is the world's premier currency, or it's not. There's a heck of a lot of grey area between it. And we just moved from an environment where, look, it was unabashedly the only serious reserve currency to, hang on, Europe's looking more interesting now. If Germany does a lot more Bund issuance, there's more Bunds to park the money in. If Europe's getting more serious about defence, US policy uncertainty, we've seen over the last few months what that is. It's just kind of taking the edge off. There is literally no alternative to the US dollar and US assets from 6 months ago. There's still no massive, huge liquid alternative, but there are some other kind of currencies and countries kind of popping their head up. So look, I think both make sense, and like that's the kind of the backdrop coming into this year. The dollar was overvalued, dollar assets were overowned. There's a vulnerability in search of a trigger, and with European, well, German fiscal policy and US policy uncertainty, you've got enough. So it's just going from extremes in valuations, and there is no other place to be to, well, hang on, maybe I can reallocate to some other places. So just it's a moderately negative dollar bearish picture than it's been for quite a while.
Tim, I can find you a big bond market. I don't know about a liquid one, Japan. Let's talk about the move in Japanese yields over the last several weeks or so. And just talk to us from the perspective of the Japanese investor, which has been a major creditor to the rest of the world for a long, long time. How is that behavior changing over in Japan?
Yeah, like I'd say a little bit, not a lot. I think in time, I mean, there's a huge foreign asset pile that Japanese investors have, and the hedge ratios are about as low as they've ever been. So there's huge potential for those guys to kind of bring it home. Are they doing it yet? I mean, Japan's the one country where we get really good timely data, and it says no, they're not doing it at all. Old habits die hard. Yields are still higher overseas, even though they're creeping up in Japan. So the scene's set for a bit of that reallocation. It's not really happening yet. Maybe there's some changing in hedging behaviour that's affecting currency markets. But more broadly, we've got the global investor group going very, very long yen in anticipation of all this happening. So I think that will happen in time. But right now, Japan investors are sitting there kind of umming and ahhing. It's been the norm for 10, 15 years we go overseas for yield. Japan yields backing up, particularly the long end of the curve. I think that will prove enticing for Japanese lifers. Why pay up hedging costs to be in foreign assets? Or why take the open FX risk when JGBs can give you 1.5% to 2.5%? That's not a massive yield for non-Japan investors, but it's pretty good for what Japan's been accustomed to. So I think that's a matter of time. I also think the BOJ is really behind the curve. Japan has nominal GDP growth trending around 4% and a policy rate of 0.5. That's really out of whack. Not many countries have that kind of gap between their growth and their policy rate. Maybe that's part of the reason that the back end is selling off, as well as global factors. Because real yields aren't moving. There's a bit of concern that maybe the BOJ is falling behind the curve. Inflation's curling back up. We've seen the data out overnight. It's the one G10 country where inflation is going the wrong way, and the central bank's still being quite relatively dovish, I'd say.
Tim, that was a clinic. We appreciate your time. Let's do it again soon. Tim Baker there of Deutsche Bank. At the end there on what's happening with Japan. And the very end of that conversation, I think, is so important to explain what's happening with the global bond market. It's not enough just to focus on Washington and the tax bill. You've got to talk about that piece of it.
Especially given the fact that Japanese CPI came in much hotter than expected on the heels of energy and food inflation, rice in particular, up almost 100%, which is the most in records going back to 1971. But Japanese buyers, investors, have been some of the biggest buyers of U.S. assets over the number of years. So if they can suddenly start funneling their money back into Japanese assets, that completely changes the investment paradigm for a lot of assets, particularly corporate bonds and stocks in the U.S.
Not just U.S., European,
yes,
too. There's a lot to look at here. Price shapes narrative. It can also reinforce behaviour, and the behaviour of the Japanese investor is one to watch over the next several years, that's for sure. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Let's cross over to Yahira. Hey, Yahira.
Hi, John. The U.S. Senate has voted to block a California program banning gas-powered cars and vehicles by 2035. The decision rolls back an EPA waiver issued under President Joe Biden, allowing California to set stricter emission standards than the U.S. government's requirements. Meanwhile, the Trump administration's Make America Healthy Again Commission report has been released. It blames the rise in chronic diseases on chemicals, unhealthy food ingredients, and over-reliance on medication. Policy recommendations based on the report are anticipated by mid-August. And Bitcoin surged to a new record high, passing $111,000 for the first time. The new highs came as President Trump hosted a dinner for top holders of his meme coin at his golf club near Washington last night. Other institutional investors have been piling into the asset, like Michael Saylor's MicroStrategy, which has amassed over $60 billion worth of Bitcoin. That's your Bloomberg Brief. John?
Yahira, thank you. Appreciate it. More from Yahira in the next hour. Up next, the great repatriation.
European investors are actually putting money to work in their own equity market. They used to get inflows and then put it all to work in the U.S. This global asset reallocation story is already underway.
That conversation up next with Biana Manthi of Citi from New York City. You're watching Bloomberg TV.
In case you missed it on Balance of Power.
If we're going to get all this revenue from tariffs, why would the president be pushing for higher taxes on anybody? Because our understanding is for the wealthy, he's looking at a new rate of 39.6%. And I thought the Republican Party didn't stand for that kind of thing.
Well, you realize that the tariff revenues doesn't count toward the reconciliation numbers. Don't ask why. I can't understand why. We're running it like 20, 25 billion a month, and they're not counting it, but we'll leave that aside for another day. This is Washington. They have their own accounting practices. So the president's trying to make sure he gets no tax on tips, no tax on overtime, and no tax on Social Security. And if he says, look, the richest Americans, remember, he cut it from 39.6 to 37. So if he just goes back to what he did last time, you know, I'm in favor of that. I think it's smart.
Don't miss Balance of Power live every weekday.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Equity stable going into the long weekend, just about unchanged on both the S&P and on the Nasdaq too. Under surveillance this morning, the great repatriation.
Global investors, rightfully so, have built up very large overweights to U.S. assets over the last 5-10 years. We are starting to see incremental signs of, it's not that there's a lot of selling of U.S. assets, but incrementally less inflows. European investors are actually putting money to work in their own equity market. They used to get inflows and then put it all to work in the U.S. This global asset reallocation story is already underway.
It's the latest this morning. US stocks on track for their worst week in over a month as European markets are set for their 6th consecutive week of gains. Biana Manthi of Citi is bullish on Europe, writing, we may have already moved past peak earnings uncertainty. If so, this should be conducive to further cyclical outperformance. Biana joins us now for more. Biana, welcome to the program. And first of all, shout out to you for making a wonderful call on European equities in the back half of last year at a time when many, many people hadn't jumped on board with that call. You think it can continue. I'd like to know from your perspective whether you view this as a diversification trade, just diversifying from the US to international equities, or a repatriation trade, European investors bringing their money home.
I think it is a bit of both. So back at the end of last year, when we made this brave call of putting Europe back to overweight, we were suggesting all the money is in one trade. There is a need for diversification, at least. And back then it was a tactical trade. But what has happened since then, and especially the tailwinds from the surprise scale of stimulus out of the US, makes that trade not just a trade, but a very interesting asset allocation proposition, because it's really going to uncap EPS growth and GDP growth for Europe. And that has been the reason for this multi-year underperformance in the post-GFC world, right? So we continue to be overweight, but for very different reasons, and I would say better reasons than before.
How much of this is really driven in part by the currency, what we're hearing from everybody, which is that suddenly there is an alternative, as we were just talking from Deutsche Bank. There's this question, how much is that a huge driver?
So when it comes to the European market, the exposure to the US dollar is 50-50, right? 50% of the sales in Europe is domestic, 50% is international. So when the dollar, so back at the end of last year, I was getting pushback. So dollar is strong. It is the end. You cannot go overweight Europe. But of course, this was where you were buying the international exposure. Right now, you're buying in Europe local domestic exposure, and that domestic exposure is particularly vulnerable, positively exposed to what is happening, what is going to be positively affected by the stimulus, right? So it's not a straight line in terms of how the currency translates into earnings and pressures or upsides for European equity markets. It's more of a 50-50. But overall, of course, if you're a US dollar-denominated investor, weakness in the US dollar moving forward that we think is going to continue. We have another 5% appreciation of euro versus the US dollar. That makes you reconsider keeping your money in the US assets and perhaps diversifying even more.
How much, Beata, are you concerned that as the tariff agreements continue, there is going to be a greater hit to profitability that hasn't been factored in on the European side, even as US companies start to game it out much more on a lot of earnings calls?
The market has bounced back very quickly, and as you say, the uncertainty remains, right? We don't know when, if the deal is going to be made. But as Jonathan has read one of statements from our reports, we've been suggesting that peak uncertainty on earnings is behind us. And we've been measuring it via really peak bearishness from the analysts' forecasts not so long ago. Back 4 weeks ago, we were highlighting that our proprietary earnings revision index has hit recessionary levels of -60. So to get -60, it happened only 2% of the time historically, and it means for every 10 changes in estimates, you have 8 downgrades and 2 upgrades. So huge amount of downgrades has already happened. In Europe, analysts have been expecting EPS growth of around 8-9% at the start of the year. They are at 3% now. So huge amount of downgrades has already happened. Now, of course, if we have no deal at all, and there is a recession that opens the road ahead and increases the odds of the US recession then spilling over into the rest of the world. Of course, our estimates are not correct, right? But for now, we still think that we could end up for the EPS growth in the low single digits growth where the analysts are right now. But one thing is pressures to growth, and another thing is how much beforehand the market discounts that in the prices, right? So at the low of the correction, our models were suggesting that actually flat EPS growth has been priced in by the market.
Beata, we've got to go. Credit to you and the team. Great to get an update from you. Beata Matthew there of Citi. We're always focused on these pockets of tension. A lot of people believe that peak policy uncertainty is behind us. We haven't seen the impact of the policy yet. Still got to wait.
People say the uncertainty worse than the policy itself. We'll have to see. What is the policy?
And what does the outcome look like? Up next on the program, Dan Greenhouse of Solos Alternative Asset Management, Tyler Kendall, the Kayak CEO, and Jim Bianco of Bianco Research.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
And Davos, you were asking a question of President Trump, and he didn't quite answer the question, and he asked you a question. So the question he asked you was something like, why are you not banking certain groups? What is the answer? I don't think he gave you a chance to really answer that question, but what is the answer to that question?
Well, first off, the Bank of America has 70 million consumer customers and millions of small businesses all over the country, all over the world. And so we bank everybody. But the real question was about overregulation, frankly. And so as you look, what's happened is because the interpretations of AML, anti-money laundering, BSA, Bank Secrecy Act, KYC, know your customer, know your customer's customer. You know, there's a lot of burden upon the banking system to both report suspicious activity reports and do a lot of analysis. And we have to close accounts, so we can't tell people why we did it. And often we're told by authorities to close accounts. That creates confusion. Another area comes up in this discussion is in the crypto area where the regulator said you can't bank crypto operating companies, employees of crypto companies, et cetera. We are allowed to do, we bank everybody, but the operating company, they said that's a high-risk activity. Ask us for authority, and guess what? You would have never gotten the authority. So that came up as an issue. So at the end of the day, it's about getting these regulations right.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Foundation of risk assets is in many respects the 10-year.
We need to see a little more damage done by the bond markets before it becomes front and center for equities.
Investors' concerns are manifesting itself in term premium and kind of wait and see mode.
The equity market already is being somewhat pressured, but I think the pressures would likely grow.
The Trump put is clearly back on the table.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning to you all. The second hour of Bloomberg Surveillance starts right now as we get closer and closer to the beginning of that long weekend. Equity futures on the S&P 500 totally unchanged. Likewise on the Nasdaq, following 3 days of losses on the S&P, and a little bit of tension this week in the bond market. Let's talk about it. 2-year, 10-year, 30-year. 30-year yields this morning still north of 5%, but stabilizing at 5.03%.
The why behind this is important. A lot of people are saying it's the fiscal backdrop, it's the discussion in Washington, D.C., it's the one big, beautiful bill that has an estimated price tag of $1.5 trillion over the next 10 years in terms of the addition to the deficit. That said, there are a lot of other pressures. We've been talking about it, how this is a global move, and there is something else that's going on, and that is the reason why some people are saying maybe it's gone a little too far, and that's why you're seeing some buying.
The move in Japan. Let's talk about Japanese investors. CPI overnight came in hot. Yields have pulled back, but the move in Japan is the one to watch. The fact of the matter is, and we talked about this briefly in the previous hour, if you're just tuning in, welcome. Japanese yields are up this week as much as US yields are, and UK yields are up by even more. This is not just a US story. I know we have got a home bias and we want to talk about Washington, D.C. and the big bill going through, and it's important, but it's not the only feature of this bond market move.
When you talk about Japan, it's important to note that, yes, this is not a very liquid market. Yes, this is not a market that a lot of people have been in because it's been entirely dominated by government purchases over the past decade or two. At the same time, Japanese investors have really fueled a lot of the buying overseas for decades. If they suddenly have yield at home, if they suddenly have a GDP that warrants the Bank of Japan to raise rates, that will be a big sucking sound, as you pointed out the last hour, back into Japan and away from the US and European assets. This is a global story. It is driven by inflation, it is driven by fiscal spending, and it is driven by the hangover after years and years of being on the heroin drip that has been quantitative easing and low rates.
The BOJ balance sheet.
Yes, exactly.
Is that the drug dealer in all of this?
That was quite the drug dealer.
I'm sure the BOJ governor appreciates that kind of language this morning. Yields are lower this morning over in Japan if you're waking up going into the weekend. Coming up this hour, Dan Greenhouse of Solace Alternative Asset Management as the equity rebound stalls. The Kayak CEO, Steve Hafner, on the outlook for summer travel. And we'll catch up with Jim Bianco of Bianco Research with long-term treasuries looking like risk assets at times through this week. We begin this hour with stocks steady, on track for their worst week in a little more than a month. Dan Greenhouse of Solace Alternative Asset Management staying optimistic, writing the relatively healthy economic and labour market backdrop will soon benefit from a $20 drop in oil prices and a signed tax bill later, which should provide for some additional stimulus. Dan joins us around the table for more. Dan, good morning. Good to see you.
Good morning to you guys. Thank you.
Let's start in the bond market. We've demonstrated over the last few years that we can handle yields between 4 and 5%. Anything concerning about these levels?
Well, they're certainly higher than they were, but I think the points you were making yesterday with Greg Peters, I think it was yesterday, that we've been here before, and it generally corresponds to some equity turbulence up at these levels, but ultimately we are 10%, 15%, excuse me, 20% higher in equity valuations from those respective levels, I think holds true. I mean, clearly, Lisa, I think you laid it out. There's a number of things going on around the world that are pushing up not just U.S. bond yields, but global bond yields, Japan in particular. Japan's CPI overnight, as you mentioned, came in a little hotter. They have a bit of an inflation problem, so there's the idea that maybe the BOJ is behind. They obviously are taking on a greater defense responsibility, something you're seeing also in Europe, particularly in Germany. And here in the U.S., well, I don't think the downgrade matters really at all, so I guess I'm less than everybody else who's expressed any value to that announcement. You do have a combination of stickier, higher inflation and the budget bill, which right now looks to be maybe $1 trillion more deficit expanding than perhaps originally anticipated.
The last time we had a downgrade, and I'm sure you've been following this on this program, was back in August 23.
Yeah.
That back then, of course, was Fitch, I believe, and it was around the same time we had the quarterly refunding announcement, and it forced some corrective action from Secretary Yellen, which did contribute to yields falling back. Do you see any corrective action this time around, or does that make a difference?
The truth is, I don't know. What I will say is that previous episode, the Fitch downgrade, was probably and I think this is relevant, the first time in my career, and I'm now solidly mid-career here. What, Lisa, you're laughing. You think I'm advanced?
No, it's just, you know, it's something you want to tell us. Carry on.
Don't let the moisturizing regimes fool
You're doing
you.
great. You're doing great.
That was really the first time in my career that the people who worried about budget deficits actually could point to something and say, oh, look, it's actually showing up in somewhere besides my rhetoric. And I think that's important because we've worried about the budget deficit. I went back and just reviewed newspaper articles just to remind myself, this goes back decades and decades and decades and decades. Not that we don't know this, but seeing it in print, people worrying in 1983, 1999, I picked random dates, and there's invariably an article worrying about the unsustainability of deficits. Is it finally coming to pass today? Perhaps, but the point I wanted to make is the 10-year yield in the U.S. is up, let's call it 50 basis points from Liberation Day. During the bond market massacre, kids out there, Google it, in 1994, yields were up almost basically 300 basis points in a year from called fall 93 to fall 94. 300 basis points from, I'm rounding, from 5% to 8%. We're not experiencing anything like that today. That, of course, was the famous episode when James Carville said he wanted to come back as the bond market. Japan, in the long end, is certainly experiencing maybe something like that, but I don't see anything like that in the U.S.
If you put these two stories together, though, it has a very different feel, which is that the rest of the world is seeing yields go up. You are seeing some real concern about inflation, but also with growth in places like Europe and Japan. At the same time that there is this debt sustainability question that has been ongoing and isn't necessarily anything new. Do those stories combined create some sort of drag of money away from U.S. assets simply because there is an alternative elsewhere?
Yeah, well, listen, that story certainly manifests itself in the U.S. equity market. The idea that, well, the U.S. is now not the only place to invest. And I think there's some truth to that. I just don't think there's as much truth as everybody else makes it out to be. When you look at the best companies in the world, they are still the ones listed in the United States. They are still the mega cap tech names. And even below that, they are still the Visas of the world, et cetera, et cetera. I think on the margin, you are certainly seeing some interest in global equity markets, but I don't, when it comes to put it simply, making money, to put it crudely, I still think the U.S. is your best investment destination.
Is it worth the premium in terms of valuation that it's received for so many years, given the fact that there are alternatives, not only in other countries that have potentially fiscal stimulus at the same time as potentially the central banks lowering rates faster than the Federal Reserve, but also simply because bonds are offering a pretty good yield in a lot of ways?
Well, listen, for a lot of investors, if you're targeting 7, 8, 9% annualized returns, and in the U.S. you can get 4.5% risk-free, a good chunk of your return profile is achieved just by increasing your allocation to bonds. But that's not, listen, we're a hedge fund for the 100th time, not an RIA. 4.5% is not going to cut it for a lot of investors. It's going to cut it for some, but not for us, that's for sure. So yes, I think there's some truth in that, but the valuation premium is largely, not exclusively, but largely concentrated in the mega cap tech names. A lot of other spaces of the U.S. are not as screamingly overvalued as perhaps as large cap tech is. And I would even push back on that idea because of the growth profile. Sure, there are some like Apple that have less attractive growth profiles, but if you're, well, now that I'm thinking out loud, Google and Meta are dealing with fiscal issues with the government.
Are you undermining your own argument in real time?
I think this is a sign of intellectual
I know, exactly. Please keep going.
No, listen, for most of those companies, they are doing exceptionally well. They're expected to continue doing exceptionally well. And I think there's a reason why they trade at, for many of them, above market multiples. Google obviously might be an exception. But again, when you look around the world, I just don't see companies listed in France, listed in Italy, or even in the UK, that compete with those types of companies.
You used the phrase in that response. Before you moved over to equities, you said risk-free. You talked about 4.5% and then said risk-free.
Sure.
We've spoken to a lot of people in the bond market who don't believe that is a risk-free asset anymore. They think anything further out along the curve performs as a risk asset. And we should talk about what we mean by that. How does it perform when you see a downturn in equity markets?
Yeah, and you had this conversation the other day, which I thought was very interesting. I would push back on the idea that the 10-year yield is not risk-free. Now, mind you, we've had some version of this conversation since really 2010. Listen, it's existed as long as the budget debate has existed, but the real firing up of that debate began in 2010 with quantitative easing, et cetera. I don't want to say I don't care. I don't believe we own a printing press. You will get your money back. It might be in devalued dollars, but you will get your money back. And in that sense, I reject the idea that the yield is not risk-free. Now, that's not to say you won't have volatility in the interim. And that's volatility, depending on how we want to have this conversation, volatility is risk. But you are getting your money back. Of that, I feel very confident. And even in the experience we're having now, there's an increase in volatility, but it's not, if you talk to the guys who live, and girls who live in the fixed income market, they'll tell you the volatility that's being experienced in the US bond market right now is not historically high. It is an orderly backup. Yes, the vol is a little elevated, particularly at the long end relative to the short end, but that skew is not suggestive of anything going wrong. It's just, to Lisa's point, I think investors repricing a budget, an inflation profile that perhaps wasn't exactly what they thought previously.
It's important to understand time frame here. When you talk about it not being risk-free, over the long term, if you're going to hold that 30-year treasury for 30 years, you're going to get your money back, hallelujah. If you're trading in the near term,
Sure.
you are seeing some pretty big volatility. And you said you're a hedge fund. Yes, you are. And a lot of hedge funds have been playing in 30-year treasuries because they have been so volatile and potentially return worthy or not. I'm just wondering at what point you get interested in them if you're looking for something more than 4.5%. And you know what? That volatility creates a lot of entry points and exit points.
Yeah, listen, for us specifically, we don't really play. We don't really trade the market. We have over time been long or short treasuries as a trade, but it's not something that we do regularly. But I agree. I mean, listen, to really make money, vol is your friend. And this is the dirty little secret. Obviously, markets go up, markets go down, and a lot of people suffer from that volatility. But if you're a trading desk at UBS or Barclays, you love the vol. If you're a hedge fund that tries to trade around this stuff, you love the vol. And in that sense, this is a terrific trading environment. Does it get more interesting at 513 or wherever the 30-year sits, 450 for the 10-year? Yeah, to some degree. But again, Solus doesn't target 4.5% returns. We're trying to get mid-double-digit returns from various asset classes. And so can I get some of that from the 10-year? Sure. Is that going to do the job for our investors? Probably not.
I think it's easy to say right now that the problem with the Treasury market, for me at least, is not the level. It's not even the speed of the move. It's the correlation with other asset classes.
Yeah.
It's the fact it's moving in lockstep with equities. It's the fact that the dollar's weaker, even though yields are higher. That's what I think is most concerning about the performance of Treasuries over the last month.
I couldn't agree more. The concept of risk is that it has not traditionally been this kind of, correlated asset. It has been negatively correlated to risk assets, and the fact that that's not predictable creates more risk in people's portfolio. That is what I think a lot of people are talking about when you say suddenly there's new risk.
Have you seen this from Michael Hartner this morning at Bank of America? Treasury yields are now higher than the Microsoft bond yields out 3 years. 30-year Treasury Microsoft yield spread is now 20 basis points. It's the tightest ever.
Yeah, well, we've seen this, and this has been something that's been ongoing. And that's one reason why people are increasingly looking at treasuries over stocks, because that is what you are seeing, is that you're actually getting more yield from the risk-free asset. And that's what potentially could reduce that premium.
What do you think of that tightness between corporate credit and treasuries?
Yeah, I saw the story about Microsoft. I will say, commensurate with this conversation, there is this idea that now that you have some corporates trading inside of governments, I saw in a story, it might have been Michael Hartnett who was quoted, but in that story, someone was saying, this is the cue for governments to get their house in order. I reject that entirely. I don't think that this government, and by this I don't mean right now, I mean the U.S. government has not shown in our lifetimes any willingness to be fiscally sustainable or responsible in any capacity, and I don't expect that anytime soon. This is a story that has been with us for 30 years and remains. And I in that sense, DOGE, for all of its flaws and public flailing that it came in for, was like the first in our lifetime serious attempt on the part of the government to try to do something, to try to root out fraud. What one man's waste is another man's responsible spending. But that was the first real attempt, and it was flogged. And that tells you, I think, all you need to know.
Dan Greenhouse of Solus Alternative Asset Management is going to be sticking with us for another segment. Let's give you an update on stories elsewhere this morning. With your Bloomberg Brief, here's Yahara Anand. Hey, Yahara.
Hi, John. President Donald Trump's big, beautiful tax and spending bill is heading to the Senate. This after the House passed it yesterday by a slim margin. The president posting on Truth Social, quote, "This is arguably the most significant piece of legislation that will ever be signed in the history of our country. It's time for our friends in the Senate to get to work." Meanwhile, the Trump administration has barred Harvard University from enrolling international students. The move is threatening to disrupt the education of thousands of students who make up more than a quarter of the school's student body. The White House cited the school's failure to address widespread problems impacting students, including anti-Semitism. And a check on Ross store shares, they are falling 11.7% after the discount retailer withdrew its 2025 fiscal forecast, warning tariffs may weigh on profitability this year. Ross also joining a growing list of retailers considering price hikes to combat inflation, though it says it will be very careful due to its value-seeking shoppers. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate it. Up next, the president's tax bill heads to the Senate.
We look forward to the Senate's timely consideration of this once-in-a-generation legislation. We stand ready to continue our work together to deliver on the one big, beautiful bill, as President Trump named it himself.
That conversation up next with Bloomberg's Tyler Kendall down in Washington, D.C., live from New York City this morning. Good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Later on this morning, must watch a conversation with the Treasury Secretary, Scott Bessent. Look out for this at 11:30 Eastern Time. What a week for the bond market. What a week for Washington, D.C., pushing through a big tax package, advancing in Washington onto the Senate. The Treasury Secretary, I imagine we'll have some comments on that a little bit later on this morning. Under surveillance this morning, the President's tax bill heads to the Senate.
We look forward to the Senate's timely consideration of this once-in-a-generation legislation. We stand ready to continue our work together to deliver on the one big beautiful bill, as President Trump named it himself. We're going to send that to his desk. We're going to get it there by Independence Day on July 4th, and we are going to celebrate a new golden age in America.
So here's the latest this morning. President Trump's signature tax and spending package heading to the Senate after narrowly passing in the House. Bloomberg's Tyler Kendall joins us now from Washington for more. Tyler, how different is this bill going to look once the Senate has finished with it?
Yeah, hey, John. Well, we'll have to see, but at the moment, it does seem like the Senate really does want to make their mark on the legislation, and we have to keep in mind it's going to be the same sort of balancing act that we saw in the House. There does appear to be an agreement emerging that many of these senators want to see some of the temporary tax cuts made permanent, particularly when it comes to businesses. Think the R&D incentives, the bonus depreciation for factories built in the U.S. Also, along the line of businesses, we're seeing some senators really raise concerns about how quickly the clean energy tax credits are being rolled back, saying that that could undermine and undercut investment in their states over the long run. Now, on an individual basis, we're starting to see some fissures emerge when it comes to changes to those benefit programs. Maybe not necessarily with implementing the Medicaid work requirements, but how fast they're going into place, not to mention that the House plan is freezing the Medicaid provider tax, which the Senate doesn't seem on board with, plus SNAP, the Supplemental Nutrition Assistance Program. Senators don't like that the House plan is going to force the states to cover some of those food assistance costs. And this is going to keep coming up because it's a politically fraught issue for the party as they contend with it ahead of the midterms. Now, of course, we're closely going to be watching what was at the core of the House agreement, which was lifting that SALT cap to $40,000. As you well know, many senators aren't necessarily inclined to keep it there. They're not actively engaged with it, and it's going to get pushback from those senators that want to see some more savings. In fact, Senator Ron Johnson has already come out and said that the SALT cap is really the first thing on the chopping block in his mind when it comes to the Senate plan. We'll have to see how it all shakes out, John, because House Speaker Mike Johnson is making the case to senators. He wants minimal changes to this bill in order to maximize their chances of getting this all done by July 4th.
Tyler, sit tight because we got some news. This from the president on Apple, posting this just moments ago. I'm going to read this verbatim for you all sitting at home. If you're tracking this, look at the stock. We're down by 3% at the pre-market. I've long informed Tim Cook of Apple that I expect their iPhones that will be sold in the United States of America will be manufactured and built in the United States, not India or any place else. If that is not the case, a tariff of at least 25% must be paid by Apple to the U.S. Thank you for your attention to this matter. This drops, the stock drops, the equity market pulls back by 1/3%.
Yeah, this really builds on what President Trump has talked about before, which is this isn't a make India great again kind of bill. I do wonder, though, based on what we've heard from Dan Ives, that it would cost twice as much for iPhones should they be built in New Jersey with all the people who are clamoring to build iPhones. I also love that he said, thank you for your attention to this matter, which is the class of passive-aggressive. It's like number 3 on the passive-aggressive notes that people can write in work emails.
You know, whether this changes or not, and I don't know, but this is just a pure observation. Go back a week, the Middle East. Who did he call out? Who wasn't in the room? Tim Cook. Who was celebrated in the first term? Tim Cook. What did we call him on this program? The diplomat, Tim Cook, who knows how to navigate the Trump administration and avoid a situation like this. What has changed between those two individuals?
You know, this is a great question. How much of it is driven by business concerns? How much of it is driven by proximity, right? Jensen Huang was the person who was traveling with him, so the person closest to him maybe gets the biggest concessions when it comes to leeway. But it's a great question. How does one curry favor in order not to be called out in a truth, which is the nightmare for so many different executives?
Tyler, just to bring you back into the conversation, to Lisa's point, this is the nightmare for the C-suite, that you go to bed and then you wake up to a social media post that looks like that and it names your company and the CEO.
Right, exactly. And it continues what really has been pressure from this White House on the private sector to conform with what they ultimately want to see be the end goal here, which is that the administration really highlights this investment that they've been getting in the broader goal to boost domestic manufacturing. And that argument is becoming very important for this White House as they contend with these concerns about the deficit, because they want to show these other sources of revenue raisers outside of what Congress is ultimately doing to help them achieve what they say will be boosting or stabilizing that debt to GDP ratio.
Tyler Kendall with the latest down in Washington. Apple is down in the pre-market right now by about 4%. Dan Greenhouse of Solace Alternative Asset Management is still with us. Dan, you've been tracking this too. This is the nightmare of the C-suite, to Lisa's point. The single name risk with the President of the United States tweeting or posting a social media post in your direction.
Yeah, you mentioned it, that Apple had been conspicuously absent from a couple of events. Jensen was there, and we know Mark Zuckerberg's been up to the White House, and obviously Apple appears to be the odd man out. I mean, listen, Dan Ives said it, the Wall Street Journal has said it, everybody who follows Apple even casually knows you start producing iPhones in the United States and the price is going to go up meaningfully. Now, mind you, Apple is a company with, I think, 30% EBITDA margins. So not that there's, that's an excuse, but there's some room to spare there. But if you're the president, someone is telling you they've got room to spare.
There's a larger question here for investors. How do you price in truth risk?
I think for most companies, you're unlikely, President Trump is very unlikely to tweet about the president of Skechers. And not that that's an excuse.
Just because you've said that, watch, that truth is going to come out. Well, make your Skechers in New Jersey.
Shoes are probably not getting made in the United States anytime soon. Although I would have told you 5 minutes ago, iPhones are probably not getting made in the United States either. Listen, Apple's in a very tough situation here. They're coming out of China. We know they're ramping up their production in India. We know. I think if you're Tim Cook, you're probably figuring, I'm going to ride this out and wait for the next administration, which presumably won't feel the same way. I don't know that that is what's going to happen. I have no inside information, obviously.
That could be a tough ride.
We've got 3 years. That's a bumpy ride, but that might be your best, given the hit to profitability on each iPhone, that might be your best option.
This underscores 2 points, I think. One, there's no favorites this time around, and it's not Tim Cook, if it was last time around. And two, the tariff risk is not over, based on a move you're seeing on their name this morning off the back of that post.
July 9th, those reciprocal tariff pause is going to be over, and you're going to have to understand what's the new regime and who gets most penalized by it.
Dan, this was fun.
Thank you, as always.
Enjoy the weekend, sir. Thank you. Dan Greenhouse there of Solos Alternative Asset Management. Up next on the program, the Kayak CEO, Steve Hafner, on the outlook for summer travel.
flood of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince. Concerned that none of the guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
3-day losing streak on the S&P 500. Things were just about unchanged on the S&P until a few moments ago. Equities pulled back by 1/3 of 1% on the S&P, and the Nasdaq down by 0.4 of 1%. There is one mover, and one mover specifically in mind, and it's Apple. Let's get your morning movers. Here's Yahara. Hey, Yahara.
Exactly, John. Apple is down 3% in the pre-market, with the president just now threatening at least 25% tariffs on the company. He says, I expect their iPhones sold in the United States will be manufactured and built in the United States, not India or any place else. And we know Apple was working to divert production from China to India, but now it has this to contend with. Meanwhile, I want to show you these next two movers. Both made their public debuts yesterday and delivered double-digit gains, and both are up again today. That is Hinge Health up 3%, Mountain Health up 0.7%. Both were reported to have delayed their IPOs due to all the market turbulence we saw in April, but now the IPO market looks to be flashing signs of life here. And last up, I want to highlight Ross Stores. Shares are falling nearly 12% now. We thought that these discount retailers were going to be insulated from tariffs since they typically procure items other stores don't want or couldn't sell. But no, Ross Stores says that over half their merchandise comes from China. So it will be taking a hit from tariffs, so it's withdrawing its guidance. And as I said, shares are down nearly 12%. John?
Yahara, thank you. A little bit earlier I said it was quiet. I have to admit, it was on the edge of boring going into the long weekend stateside, and maybe boring was welcomed after the last month we've had, but it gets a little bit more interesting with this post from the president and this move in Apple. On our radar this morning, President Donald Trump threatening tariffs on Apple, posting, I expect their iPhones that will be sold in the United States will be manufactured and built in the United States. If that's not the case, a tariff of at least 25% must be paid.
I'm curious what the ask is, because there are other products that are not being made in the United States. Is it just that Tim Cook doesn't announce a plan to move some of the production to India? Again, it's important to understand the context. We were just talking to Dan Solis, and he said there's no chance that all of the shoes that we wear are going to be made in the United States. So why is it that one product will be made here and not another? Is there a national security component? Is it just who's closest to the president? That kind of standard, I think, is important for people to understand what the framework is and how realistic it is that those iPhone prices are going to go up 25% to 50%.
Not just one product, one company's product.
Right.
How does this work in practice? Typically, we associate tariffs with a single country, not a single company and a single product being exported from a certain country. I'm not sure how this would work in practice.
This really highlights the concern for people who are saying that we've reached peak uncertainty. Peak uncertainty of what? Especially given the fact that we haven't seen the actual deals come to fruition. There have to be some deals that come out of the woodwork by July 9th in order to avoid some of these additional tariffs. But again, it just highlights the ambiguity around policy. When people say policy risk in the United States, it is both on a macro level and it is on a micro level, with one of the tech champions that we came into this country saying that this administration was going to uphold and prop up and hold dear.
Yeah, you go back to the inauguration.
Exactly.
And all the tech CEOs standing there. And I remember the day after I sat there on set and I said this was a celebration of everything that was great about US technology, and that we thought we had an administration that would take care of them, look after them, celebrate their success. This underscores two things. We mentioned it briefly. One is exactly that, precisely. The tariff uncertainty is not over at all. We've just switched our attention to taxes for a while. The tariff story is not over. But two, the personality involved here. Tim Cook, compare and contrast. We were calling him the diplomat. Tim Cook in the first administration, the first term of the president, Donald Trump in the second term. Over the last week or so, I would love to find out what's happened here. Not in the Middle East, called out for not being in the Middle East, and then this morning.
Yeah, it seems as if there was a trigger. It always seems like there's a trigger. And so to understand what that trigger is might help certain executives stay out of the limelight, because it feels like from some discussions that is a desire. Put your head down, just keep to your knitting for 3 years, not really talking about anything with anyone, don't make waves, and then you can go back to trying to go to some more status quo.
That's the point, making waves. Do you think they were too public about moving production to India? Do you think they were saying that a little bit too loudly for the administration's liking?
There are narratives that come out of the woodwork. One of them was Walmart raising prices. All of a sudden, truth came through, hitting Walmart.
Bezos.
Exactly. Bezos, same thing. This is a tariff-related charge on Amazon. And now you have Apple that came out and people were saying, look, it's not going to benefit the U.S. iPhone production is just going to go to India, and they said they were going to move their production there. It just is a question of narratives. And when that builds on a narrative, it seems like that invokes the ire of this president.
Apple is down in the pre-market by some 2.5%. We'll return back to that story in just a moment. On the trade talks, the US and China holding their first call since trade talks in Geneva earlier this month. Both sides agreeing to keep lines of communication open, but neither saying in official statements whether tariffs were discussed.
Yeah, and I just wonder how some of the technological underpinnings really factor in. We were just talking last week about how China has come out and really slammed some of the Trump administration's plans with chip restrictions. So you look at then the more amenable tone that we heard from President Trump with respect to diffusion, with now Jensen Huang having a close tie with him. Again, it just emphasizes the point. We're not out of the woods with trade uncertainty, especially given that it's still unclear what the goal is, as a revenue raiser or as a bring production back to America.
To pay for some of this, the president's tax bill heading to the Senate. Trump saying, quote, "This is arguably the most significant piece of legislation that will ever be signed in the history of our country. It's time for our friends in the Senate to get to work."
Yeah, get to work and try to come up with something that can be agreeable to the House. Remember that both sides of the aisle, of both sides of the congressional body, need to agree on the same bill. So if they make material changes, it has to go back to the House. The House has to sign off on that, and then it has to go back to the Senate if it is changed in any kind of substantive way. It is a very ambitious plan to get this done by July 4th, and it is questionable about whether this is going to be stimulative or whether this is going to cause the yippiness in the bond market with respect to deficits.
Target date, July 4th, Independence Day, a bit more than a month away. Let's turn to the consumer. The summer travel season just around the corner. Over 40 million Americans expected to travel over what could be a record-breaking Memorial Day weekend. Joining us now to discuss, Steve Hafner, the CEO of the online travel company Kayak. Steve, welcome to the program, sir. Good morning to you. I think we just have to start with travel trends. What do they look like now? What do bookings look like? Compare and contrast them to what they did look like 12 months ago.
Sure, John. Thanks for having me on. As you say, Memorial Day weekend is upon us. It's a playoff game for the travel industry. It's not the Super Bowl. That's Thanksgiving. But gas prices are down, so you're going to see about 45 million Americans hit the road. Airfares are actually down, too. So if you look at Kayak data, domestic airfares are down 7% from last year. So airports, maybe not Newark, but airports are going to be full. We expect to see about 12 million Americans going through planes. In terms of hottest cities, domestically, it's the South, Atlanta, Tampa, Raleigh. And in terms of international destinations with deals, Stockholm, Hong Kong, Japan, Asia more broadly.
Steve, what about international travelers coming to America? Can you share any Kayak data on that? Because we've talked a lot about inbound travel really falling off. What are you seeing in your data?
Yeah, Kayak data does suggest a dip in inbound travel, particularly from Canada and Mexico to the U.S. So it seems like Canadians are doing a flyover and going to Mexico, and Mexican folks who usually come into the U.S. or go into the Caribbean. But most of our travel in the U.S. is domestic, and those trends are staying strong.
Are they staying strong across the spectrum of people who both want luxury as well as who want some price efficiency, or do you see a skew more heavily one way or another?
Yeah, the story earlier in the year was people trading up when, I think economic prospects were a little bit brighter. People in the airlines, particularly on the earnings calls, I don't know, 2 quarters ago, were talking about the rise of premium travel, the rise of business travel, people paying for earlier check-in, amenities, et cetera. That seems to have abated a bit in kayak data. So economy queries are up, basic economy queries are up more than premium economy. So we do see a bit of a downshift in consumer sentiment.
Steve, we've been trying to get a gauge of the consumer where we see these soft data surveys. University of Michigan Sentiment Survey come out at lows that we haven't seen in decades. And at the same time, we talk to credit card companies. We speak to people like yourself and say, people are still spending, they're still traveling, they still want to go on vacation, and they're still looking for a certain degree of luxury and comfort. How do you sort of square that circle in terms of which narrative is correct?
Well, I think they're both correct because there's a big substitution effect that goes on in airfares and hotels. Travel is a discretionary good. Everyone aspires to get that if they have extra money. And airlines and hoteliers are very adept at cutting price to make sure they fill those hotel rooms or fill those seats on airplanes because it's a swelling asset. So anytime you see prices coming down in the travel business, but passenger volume is staying high, you know that the laws of supply and demand are being managed pretty darn well. What we see at Kayak is a lot less international travel because in international tickets, economy is around $1,100 per seat. Domestic is around $300. So people will still travel. They'll just switch going to Europe and to Asia for domestic destinations. And that's why airfares in Europe and in Asia are down so much more than airfares here in the U.S.
Steve, I don't mean to put you on the spot, but it seems like no one really wants to talk, particularly in the C-suite, about tariff costs, about the potential changes that policy will have on businesses. I'm just wondering, from your perspective, how difficult it is to speak honestly about some of the pricing pressures that are coming out at the same time that a lot of companies and a lot of CEOs want to stay out of the spotlight with respect to this, given some of what we've seen, particularly on Truth Social.
Well, I'm glad I don't make iPhones this morning. But look, I think a lot of what you're seeing is not the timidity of CEOs, it's that they don't have anything intelligent to say because they can't predict what's going to happen with taxes and what's going to happen with tariffs and how that's going to ripple through the economy. I think a lot of the early predictions of what some of this stuff is going to do seem to be a little bit extreme based on what we've actually seen in employment data and economic data. So we'll just take a wait and see approach. So I think a lot of executives, particularly the public ones, are just saying, hey, let's pull guidance for now. We don't want to guide the street too high or too low. Let's just see how the business actually performs. And let's just see how many of these tariffs and what's actually in the budget that sticks.
Steve, before you go, this week has been exhausting. This month for many on Wall Street. Have you got any last-minute deals for the weekend? Where are people going? Where should they go?
There's still deals to be had, but honestly, if I was any of your viewers, I would look for July 4th. July 4th airfares are down 10% versus last year. There's still plenty of capacity. Go out there, chase them down. Kayak can help you do that. And then one last thing is if anyone is using ChatGPT, I presume you are, John, et cetera. There's a new flavor of Kayak out there called Kayak AI. That's ChatGPT married with Kayak data. Check it out. It's kind of fun.
Very cool. I'll go on the website and look at that. Steve, appreciate your time, sir. We'll do it again soon. Steve Hafner there, the Kayak CEO.
Yeah, I love that, the ChatGPT. It's sort of like my bot speaks to your bot, plan something beautiful for me.
July 4th, apparently.
Yeah, well,
airfares down 10%.
Actually, I noticed that. I've been looking, and airfares are down substantially, and a lot of airlines can do this because gas prices are down so much, and fuel costs are about a third of their total overhead.
Equities down this morning by about a third of 1% on the S&P. Let's get you an update on stories elsewhere with your Bloomberg Brief. Here's Yahara. Hey, Yahara.
Hi, John. You definitely jinxed our quiet morning. We start with President Donald Trump threatening Apple with tariffs, writing on Truth Social. I expect their iPhones that will be sold in the United States will be manufactured and built in the United States. If that's not the case, a tariff of at least 25% must be paid. Shares of Apple are lower 2.8% in the pre-market. Meanwhile, the EU's trade chief Maros Šefčovič and U.S. Trade Representative Jamieson Greer are set to speak today. Sources telling us here at Bloomberg The Eurozone shared a trade proposal earlier this week, but the Financial Times reporting the U.S. is expected to reject it during the call this afternoon. This as hopes of quick trade negotiations diminish in Brussels. And in sports, the Oklahoma City Thunder are up 2-0 over Minnesota in the NBA's Western Conference Finals. Freshly named league MVP Shai Gilgeous-Alexander had 38 points and 8 assists. And in hockey, the defending champion Florida Panthers are up 2-0 in their series against the Carolina Hurricanes after a 5-0 win in Game 2. That's your Bloomberg Brief. John?
Yahira, thank you. Up next on the program, Trump's latest tariff threat, the president taking on Apple. Jim Bianco of Bianco Research joins us next.
What makes it India's time?
It's us women who are going to transform India. I truly feel that the time for Indian women has come. They're not only breaking glass ceilings, but they are redefining, you know, whether it is in sport, whether it's in medicine, whether it's in creative arts. They are everywhere, and I have so much positive energy that comes back to me when I'm talking to Indian women. And I just think at all these little girls and boys, I don't want to discriminate, who are now in school-going age, imagine once education, sports, we empower them. What a difference they would make not only to India, but to the planet and the world. And the world needs it now than ever before.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything.
Bringing you up-to-the-minute geopolitical news wherever and whenever it happens. I'm Anne-Marie Hordern in Buenos Aires, Argentina, and this is Bloomberg.
Remember what Lisa said about a quiet weekend?
Excuse me.
Do you remember that earlier this morning,
no,
Quiet Friday?
You were the one that was saying, it's so quiet, it's great. You were the one that jinxed us.
It was me. I was hoping for a quiet weekend. You're not getting one. Equities are down here by more than 1% on the S&P 500. On the Nasdaq, we're down by 1.3. Over in Europe, we're down even more. Off the back of this, from the President of the United States, the European Union, which was formed for the primary purpose of taking advantage of the United States on trade, has been very difficult to deal with. I'm recommending a straight 50% tariff on the EU starting on June 1, 2025. The DAX is down 1.4%.
Yeah, then he goes on to say there's no tariff if it's built in the or manufactured in the United States. And then again, we have, for the second time this morning, thank you for your attention to this matter, exclamation point. So there's a real question here. What exactly is motivating some of these actions that he's taking?
So yesterday we discussed whether passing the bill through the House, the tax bill, would embolden the president to be harder on the Europeans on tariffs. And I just wonder if the two things are lining up here and if they are connected. Just giving him the space, the room to go harder on Europe on tariffs, because we are progressing this tax bill in Washington.
It just highlights the point. I don't know whether that's the case, but one could easily connect the dots and come to that conclusion. There is a question about whether this market has gotten overly complacent with peak uncertainty, given that it is ongoing and we still don't have any kind of sense of what the solid goal is or what the plan actually will be.
So we've got a threat against Europe. That's sending European equities south. A threat against Apple as well. Check this out. Apple in the pre-market is down by more than 3%. The president threatening tariffs of up to 25% on Apple's iPhones. The president posting on Truth Social that he expects iPhones sold in the US should be made in the US. So you've got two stories here. We're going after the Europeans on the one hand and after Apple on the other.
Have you ever tried to do even small repairs on your iPhone? I've got to say, I'm not very adept at it. I don't know that I'd be very good.
I'm not the guy with the skills to be doing those things.
Yeah, like, or trying to make sure that the screen protector is on perfectly. There always are bubbles when I try to do it. I'm just saying, I hope that there are a lot of really skilled people in New Jersey who can do that.
Jim Bianco might be one of them. Jim Bianco of Bianco Research joins us now for more. Jim, welcome to the program, sir. I was hoping for a quiet weekend. We're not getting one going into this opening bout. We've got a threat against Europe, a threat against Apple. Out of the two of those, what do you think is more important to this market this morning, Jim?
Oh, I think it's probably Europe because it's a bigger market and encompasses more goods. So we're back to tariffs on. And tariff on, I think, is going to be an interesting way for the market to try and navigate this. Does that mean that we're going to see weakness because we're going to have higher prices? Or is it because we're going to have higher prices? Which one is going to be the dominant factor? Now, when we turn it to the Federal Reserve, they usually are focused, I think, more on prices. And I think that's the thing that a lot of people on Wall Street are missing, is that all things being equal, if tariffs are coming back and prices are going up, and that might be weakness, the Fed's not going to cut rates. They're not going to cut rates until they see that prices have stabilized. And right now we might be looking at more inflation.
So, Jim, that take's important because I want to take you over to the move of the bond market off the back of this news. Yields are lower across the curve. We're down 8 basis points at the front end, 391. I know we're not breaking out of the new range, the range of the last several months, but still, yields are falling back. The 10 years down by 6 basis points, 447. What would your response to be to that early move, given that you think this ends up with more inflation down the road?
Well, that's a knee-jerk response to the stock market falling. I think what we're seeing right now on this move. But if you were to back up and go back to, when we started talking about tariffs, there's been a trend higher in yields. And the trend higher in yields is really about, as things settle down, we're looking at higher prices. As I've liked to argue, if you look at the tariffs that were collected in April, that was 1.75% increase on the $400 billion of goods. That's an extra $7.5 billion of tariffs in April, 1.75% on the $400 billion of goods that we imported in April. Who's paying that? Somebody's got to be paying that. Now, the president wants us to believe it's going to be Walmart and Apple eating those tariffs and maybe the Chinese. But if you look at numbers like Truflation and price stats and stuff, which are these millions of prices that they check on the internet, prices are going up. The prices are going up for the consumer. And I think as that continues to happen, that reality is going to drive the bond market more than a weakness reality.
One thing that we've been talking about throughout the morning, Jim, is that this is not isolated to the United States when it comes to the yield move and some of these inflation concerns. How much is this applicable in terms of a broader inflation globally in developed markets that leads bonds globally to be less attractive in the same kind of way as they were traditionally for a price action, albeit more attractive from a yield perspective?
Oh, I think you're right. It does affect all bonds worldwide, especially developed markets, because the tariffs are pushing all these markets to do trade deals. The UK and the EU have done a trade deal as well. And so what we're seeing is the opposite of globalization, which I've become aware is now the word is segmentation. So we've got a segmentation coming in global trade. And that's going to just add frictions and add more costs. And those costs are going to show up as elevated or sticky inflation. And that's going to start to impact all bond markets. And it has been, because if you look over the last month or so, developed world bond markets have been going higher. The one exception has been China, where their interest rates have been moving lower. but their economy is in such an alarming shape right now that you could almost argue that even with these higher inflationary numbers that we have, their economy is more being driven by growth than it is being driven by prices.
I'm struck by the fact that the bond yield move is not special to the United States. It is something that is global in developed markets. The move, though, in the dollar is distinct, and it is raising a lot of concern that this could be the biggest casualty of some of the trade disagreements. We are seeing a bit of a strengthening in the dollar off the heels of this news with respect to potentially higher tariffs on Europe. I just wonder whether you think that this weaker dollar theme is going to persist, even if you do get some serious, significant increases to tariffs on some of the trading partners in the U.S. At a time when a lot of people have shrugged off some of what these proposals could do.
Well, yeah, I do. I do think that the weaker dollar will persist for a couple of reasons. One, I think it's what the administration wants. It doesn't, or it's at least it's not going to complain about a weaker dollar. And the weaker dollar isn't really bringing around talk about the end of dollar dominance or the reserve currency. It shouldn't, because there isn't an alternative to it. So they want it. And the second thing is, if you've watched the currency markets long enough, you'll realize that when these things trend, they trend much further and much longer than everybody thinks. Whenever you think the dollar is overbought or oversold, the joke is, wait till you see how overbought or oversold it's about to get. And right now, it is trending lower. And I suspect that over the next several weeks or few months, that's going to continue. Even if we get higher rates, even if we get a widening of spreads to, say, Europe or something like that, that hasn't been working right now.
Jim, I just want to finish on the equity call. The equity market, there is a playbook here. The president comes out and tries to anchor negotiations with extremes. Come out and say, you're going to face a 50% tariff on June 1. You've not been great to deal with. Does the same playbook that applied to China apply to Europe? Is this different? Have we exhausted that? Because there will be a lot of people out there thinking, okay, equity futures have gapped lower. I'm going to buy that. I've seen this movie before. Is this different?
I mean, it could be. I mean, you know, the biggest issue I think that Wall Street's been struggling with is, are tariffs leverage to get a deal, or are tariffs revenue? If they're leverage, I think most people on Wall Street would be fine with that. To get a deal, you know, to use them as leverage to lower tariffs, open up trade. But are they a form of a tax on foreigners to try and raise revenue? That has been the bigger issue that we've been trying to struggle with. When it comes to Europe, I think most people think it's more in the leverage camp, and therefore this is just a negotiating ploy. When it comes to China, I think more people are worried that it's in the revenue camp, and it's more than just a leverage play. So that's why I think that when it comes to Europe, it's going to probably be viewed as a leverage play to trying to get a deal done sooner rather than later.
Jim, appreciate your time, sir. As always, it's good to see you. Jim Bianco there of Bianco Research. Following this news from the president recommending a straight 50% tariff on the European Union starting June 1, 2025. Equities in response to that lower in the US, down even more on the continent. Up next, Nadia Lovell of UBS, Dana Telsey of the Telsey Advisory Group, Joe Davis of Vanguard, and Russ Brownback of BlackRock. Live from New York, this is Bloomberg.
In 2000, post-Napster, generally everybody wrote off the recorded music industry, including the investment community. And I didn't mind that chapter, because then I got left alone. And actually, I think out of that period, we started to create better art, because the pressure wasn't on from the technology to be the most powerful chapter. And then iTunes came in, and iTunes, to Apple's credit, did have a boutique taste mentality about the store, which meant that I think they understood. I can tell you from that period that the artists that came through were of a very high quality, because it was encouraged to be boutique. Now, ironically, this chapter has made us more money times 5 than the iTunes chapter and the post-Napster chapter. But an algorithm tells you what you want, not what you might like. And there's a difference between what you want, but with streaming, the downside is you have incredible penetration, and we have hundreds of millions of people around the world. And so that has been very lucrative as a business.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
But what about the diagnosis? If the diagnosis at the end is worries about growth rates,
yeah.
How do you get from point A to point B? Why do you worry so much about that end goal of better growth?
Because if we can't grow, you're going to have a much more inflated debt to GDP and federal deficit, and that's not good for the economy. Growth is really critical, and I think what's underappreciated is what the inputs are to get to the growth number. And so we talked a little bit about productivity. I hope that we can continue to produce at 2% indefinitely on productivity. I think that would be great. But you got to make sure you have the other levers in place, I think, to buoy that. So if you look back over the last several years, we've had 8 million immigrants come into this country in the last 4 years. And that's helped growth. And by the way, that's deflationary.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
This is probably the first budget reconciliation bill that the bond market's actually paying attention to for the last 30 years.
Increasingly, it feels like this administration is going to have to confront the problems because the bond market has lost patience.
There is just a pushback globally on the back end of the curve.
When you back up yields, you begin to change the math.
Bond markets are the ones that are giving you the yellow flag and saying, you know, something perhaps isn't right here.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning to you all. This was a quiet one 2 hours ago. It's not quiet anymore. Some risk aversion kicking in. Your scores look like this. Equity futures on the S&P down by 1.5%. On the NASDAQ by 1.8%. On the Russell by more than 2 percentage points. Check out Europe. Down and down hard on the continent. The DAX, the equity benchmark in Frankfurt, Germany, down by 2.3%. And in the bond market, that risk aversion this time supporting yields lower. We're down 7 or 8 basis points on 10s to 445. We break back below 5% on a 30-year to 498 off the back of this. Just one post on social media from the President of the United States on Europe, calling them very difficult to deal with and proposing this, recommending a straight 50% tariff on the European Union starting on June 1.
For people who said we were beyond peak uncertainty and that it was the uncertainty itself that was creating a lot of the negative action in stocks, well, this is the reality check. We are not necessarily getting any kind of certainty. You could make the argument maybe it's not peak uncertainty, but we are not past the uncertainty when it comes to different policies and what could potentially get proposed. This is not over. And I think that as people focus on the tax bill, they have lost sight of that and were reminded this morning by Donald Trump.
Not once, but twice.
Yes, exactly.
This was a 1-2 combination. That was the knockout punch. The lead jab came about 30 minutes before, not even. And it was directed at Apple. Apple is down in the pre-market by more than 3%. This from the president. I've long ago informed Tim Cook of Apple that I expect their iPhones will be sold in the United States of America. They will be manufactured and built in the United States of America, not India, or any place else. If that is not the case, a tariff of at least 25% must be paid by Apple to the US.
So again, this raises the question about what the ultimate goal of some of these tariffs are. Is it for people in New Jersey, and I keep picking on New Jersey, but pick another state to be making the iPhones, or is it to bring in revenues and to redirect some of the trade, but not all of the trade, back to the United States? This just really raises the question, how much is to bring domestic production back to the United States at a time where Tim Cook has said that they would have to double the prices of iPhones if it were made here in the United States.
This hour, we've got a lot to work through. Session lows on the equity market. On the S&P, we're down by 1.4%. Coming up, we'll catch up with Nadia Lovell of UBS on why she's downgrading US equities. Timely. Dana Tausi of Tausi Advisory Group as retailers set the stage for price hikes. And Russell Brownback of BlackRock as elevated Treasury yields weigh on sentiment. We begin this hour with our top story. President Trump threatening 50% tariffs on the EU starting June 1st, and also going after Apple earlier on this morning. Joining us now from the nation's capital, Tyler Kendall. Tyler, it was quiet, it's not anymore.
Yeah, John, no. And you were the one that said it in the 6 a.m. hour that it could have been a quiet day. But at this point, we really are seeing what are really big announcements from this administration. And you have President Trump here, if we focus in on what he was saying about the European Union, saying in the Post that our discussions with them are, quote, going nowhere. We know that there has been very little progress when it comes to those talks, but perhaps we could have seen an opening later on today as we're reporting that the EU trade chief was set to have this discussion with the USTR, Jameson Greer. So perhaps this is some sort of precursor ahead of that call. We saw some impromptu diplomacy over the weekend, too, when the EU Commission President Ursula von der Leyen met with J.D. Vance in Rome for sort of a last-minute meeting amid some events related to the Pope. But really, there's some big issues going forward here. One, of course, as you well know, is that they're negotiating as a bloc, which has complicated matters among all 27 of these member states, ultimately negotiating about some of these things that the president is highlighting and has long been an issue, like those non-tariff barriers that he talks about, like the VAT or the digital services taxes, which up to this point haven't really seemed to be on the table for negotiating. And John, Bloomberg News was reporting that the EU was prepared to put forth a new proposal here that included lowering tariffs down to zero on both sides when it comes to some agricultural products and industrial goods. It doesn't appear that that really was able to move the needle here when it comes to the U.S.
You know, Tyler, you addressed some of the things that have been the big question marks. How does this all have to do with maybe, say, the VAT tax or some of these non-tariff barriers that have been brought into the discussion? I just wonder if President Trump does go ahead with that 50% tariff on June 1st, what does that mean in terms of retaliation from the European Union?
Right. And Lisa, we've already seen the EU threaten that they are going to retaliate and sort of outline some of those sectors that they are going to hit, particularly when it comes to some of those key industries that President Trump is keen to protect, like U.S. agriculture. But really, those tariffs have already been, those planned reciprocal tariffs are really in response to the sector-specific tariffs that we're seeing hit the European Union particularly hard, like the steel and aluminum tariffs as well as autos. And keep in mind, it actually was 2 weeks ago today that President Trump said that we could see some further sector-specific tariffs when it comes to pharmaceuticals go into place, not to mention, of course, we're also watching closely what's going to happen with chips as we talk about what's happening here with Apple. So these are all sort of the mitigating factors that are going to go into the broader picture of how the EU could ultimately respond.
Tyler Kendall with the latest. Tyler, stay close. Tyler with the latest down in Washington, D.C. There were signs. There were signs. Clearly, it's hit this market this morning, granted, but we've been talking about this for a while. If you go through all the reports, the encouraging words of confidence around trade deals and negotiations, I would hear things on Japan, India, heard lots on China in the last week. There was hardly anything favorable to say about Europeans and the progress that was made with the EU over the last several weeks.
Yeah, what was it? Nasty? That was the word that President Trump used about the European Union and some of the negotiations. And it comes at a time where, as Tyler was saying, there are these non-tariff barriers. We've already heard from a lot of European leaders, this is completely different than tariffs when you're talking about VAT taxes that are a tax that are done under different legislation and are a completely different way of raising revenue and that are equally applied across the board. It is a very different type of discussion that is much harder to change in the same kind of shorter time frame.
Equities down hard in Europe and down stateside too. Equity futures down by 1.6%. Here is the view on Wall Street. Nadia Lovell of UBS downgrading US equities to neutral, writing, we see limited upside near term and expect continued continued volatility as trade and U.S. fiscal uncertainty remain high. Nadia joins us now for more. Nadia, good morning.
Good morning.
How good does it feel not to defend an overweight going into the weekend?
You know, it never feels good when markets are down, but, you know, this is some of the issues that we were struggling with last week, and we were concerned about. As Lisa said, we were past peak uncertainty, but there was still uncertainty, it still remained high, and that's why we downgraded U.S. equities last week. Now, we had been attractive view on U.S. equities in April. We took that opportunity right after the 90-day pause. But after being up 13% in a month, we just thought that the risk reward was balanced. And yes, you know, the effective tariff rate has come down from 25% to 15%, but it feels like a lot of the good news was already priced in. And there's risk for it to go higher than the 15% it is currently, obviously.
Price action, as you know, can condition behavior. I just wonder how many investors have been conditioned by the experience of April. Big dislocation, then things soften and markets rip. And you can miss out really quickly. And we saw that early this week. We had this small dip off the back of a downgrade, dip gets bought. And I just wondered from your perspective whether this dip is going to be bought too, because people have got the playbook from April. Maybe they're comfortable with it. We know that the president likes to anchor negotiations to the extreme, comes out and says to Europe, make a move, otherwise you're going to get a 50% tariff, equity markets pulls back. Would you suggest people be more careful this time around, or do the same rules still apply?
Yeah, we are looking for opportunities to buy dip. You know, 1%, 2% down is not much of a dip for us. If we see a 5% down, that's a different conversation. At the same time, we also have equity valuations that have recovered. We're at 21 times forward PE, you know, above the 5-year average. So there's very little room here. And at the end of the day, we know that is earnings over the longer term that would drive markets. And we think that the consensus earnings is still too high, 9% from consensus this year. We think it needs to come down closer to 4%. So we're also waiting for just more clarity around what the tariff policies will eventually look like. You know, we thought that 90-day pause will take us to July. Obviously, now it's, you know, potentially June 1st. And remember, we still have the sectorial tariffs to come on the 5 critical sectors, you know, pharma, semis, lumber, copper, and critical minerals. And we're not sure what those exactly are going to look like. Is it 25% or is it something higher?
I'm looking at your base case. It's 6,000 in terms of year-end for the S&P 500. The bull case is 6,700. The bear case is 4,500. What could get you to feel like one or the other is the more likely tail risk?
It depends on what happens, you know, after this 90-day pause or something even shorter than that, obviously. Now, if we see, you know, a re-escalation and those reciprocal tariffs get put on or even at a higher rate, you know, that is going to have a huge drag on the economy, and that puts us closer to a recessionary scenario that would get us to that 4,500. What could get us up to that 6,700? Right now, there are legal challenges. We know, you know, you have Oregon versus Trump, you have, you know, VOS versus Trump. And there could be a decision in the next couple of weeks, potentially an injunction that will challenge, you know, the use of IEEPA for these broad-based tariffs. And the market isn't priced for that. So you could see some of that, but that's not to say that that's going to be the end of the story, because there's always a Supreme Court, and that could be taken to the Supreme Court and be reversed. But that's what could get us to that 6,700 if we get any sort of rollback, even the baseline tariffs.
Who's trading every day? And I ask this because there are so many people who come out with these conspiracy theories. It's the retail trader on the margin that's creating the buy the dip mentality, and everybody else is just following them. It's the hedge funds that are causing the volatility in the bond market. I mean, is there truth to that? That there are these technical underpinnings that are just whipsawing everything, and that we're the ones here trying to make a narrative out of it?
There is a little bit of that. And there's also systematics as well that are in the market, you know, and, you know, when you see spike in volatilities, those funds have to also respond to that. So there's some of that. You know, the retail investors have been in and out of the market. I think the retail investors right now is a little bit more hesitant to sort of buy the dip. And so that's at the end of the day, it's the flows that are driving the near-term volatility in the market. But I think that the real money is still trying to assess, you know, what economic growth is going to look like in the second half. We think that you will see the economy slow close to a 1.5%. So again, not recessionary, but again, although the range of outcome have narrowed, you know, it still can end up to be flat growth, or it could be 1.5%, dependent on trade policies and the president's tweets.
Nadia, just finally, just before you go, within that defensive posture you have relative to where you were before, what do you like in equities? What's the favored sector at the moment?
Look, we still continue to like tech. We've seen a rebound, but I would say tech excluding Apple, is in a better place than it was back in February when it was at its high. Why? We've seen, the pause on the China-U.S. tariff. We've seen a rollback of the AI diffusion rule that was supposed to go into effect last week. And so we also see a pickup in CapEx spending. Look at all the deals that have been announced, around sovereigns, CapEx spending in AI. So we think that the outlook for tech has actually improved than it was just a few weeks ago.
Nadia, appreciate your time. You knew what the follow-up would be, didn't you? Apple. Nasdaq futures right now down by 1.9%. Nadia Lovell there of UBS, always looking for a silver lining. The fact that bonds are rallying. I think given what we've seen so far this week, that's pretty good news. Yields are down by 7 or 8 basis points at the front end, and we're down on 10s by about 7 basis points too.
Good news that treasuries aren't sold in a fire sale when it comes to potential growth concerns, because this has to do with growth. So, yay.
Right? Kinda. It's all relative.
Well, yeah,
a month ago it was like dumping American assets wholesale.
Right. This is actually goes to your point of in a downturn, could the U.S. still raise money and have a situation where they're not just sort of spiraling in a sort of 1970s type of stagflationary nightmare? And there is that silver lining.
You want that orderly kind of process to work out.
I just want to point out one more time, I'd be really bad at making iPhones. Like really, really bad.
Are you concerned someone's going to try and make you make an iPhone?
I think that once they see what I actually do with it, they'll walk it back. But I think that would be a really bad.
I'm not sure who you're sending this message to, but whoever it is out there, Bramo doesn't want to make iPhones, okay? Let's give an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahira. Hey, Yahira.
Hi, John. President Donald Trump with a new slate of tariff threats. Trump taking aim at the European Union this morning, posting on Truth Social, he recommends a straight 50% tariff on the EU starting on June 1st. European stocks are sinking as a result. And here's the next one. President Donald Trump also threatening Apple with tariffs. Writing on Truth Social, I expect their iPhones that will be sold in the United States will be manufactured and built in the United States. If that's not the case, a tariff of at least 25% must be paid. Shares of Apple are lower, nearly 4% now. And the Supreme Court granted a request from the Trump administration to fire the heads of 2 independent agencies, but quickly ruled that the Federal Reserve would not be similarly targeted. The court referred to the Fed as a uniquely structured quasi-private entity, giving clarity about the fate of Fed Chair Jay Powell's future in the role. That's your Bloomberg Brief. John?
Yahira, thank you. We'll catch up with Yahira again later this hour. There's a lot to get through. We need to talk about the threat against Europe, the threat against Apple, and the market move. Equity futures down by 1.5% on the S&P. Apple is down and down hard in the pre-market. And up next, we need to talk about tariffs and retail. And we'll do that with Dana Telsey of the Telsey Advisory Group. Live from New York City, you're watching Bloomberg TV.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
The opening about 1 hour and about 13 minutes away, and your equity market's down by 1.4% on the S&P. It's down by 1.7 on the Nasdaq, and it's down by even more over in Europe. The equity benchmark in Frankfurt, Germany, the DAX is lower this morning by 2.5%. In Paris, France, we're down by 2.7%. Going into the long weekend and confronting this post from the president, accusing the Europeans of being difficult to deal with, very difficult to deal with, and threatening a 50% tariff on the EU starting on June 1. 2025.
Yeah, this comes as they have a deadline of July 9th. It's notable, as you're pointing out, John, that the declines in Europe are bigger than the ones in the U.S. It kind of challenges the point that everyone's been talking about, that maybe tariffs would hurt the United States more than all of the trading partners. Oh, wait, hold on a second. Maybe this actually goes to the potential pain in other regions as well, which was the initial narrative coming into this year.
Moving the euro is interesting, isn't it?
Yes.
I don't think people really know what to do with euro-dollar right now. Euro-dollar is still positive on the day. It's up by 0.4%. It's off session highs. It's up at 113.23. Coming into the year, we had the playbook, tariffs up, dollar stronger. Then tariffs went up and the dollar weakened. I just wonder whether we flip back to the old rule book, the old playbook all over again.
I think that you've nailed it. No one knows what to do with it. You can see it kind of bouncing around. It is off the session highs, but it still is up. And it just goes to show that people have a hard time gaming out exactly how this is going to look, given the fact that we don't really understand the objectives or exactly which industries are going to get hit hardest.
From the perspective of rate differentials, I think it's easier to sit here this morning and build an argument that rates are going to have to drop a heck of a lot more in Europe, given the fact that they face that disinflationary shock off the back of this and all the Chinese overcapacity they might have to eat. If the wars do stay up, stateside, yields are down in Germany. The 10-year Bund yield is down on my screen right now by 8 basis points on 10s, and at the front end down by 8 also. And you've got an ECB that seems to be a lot more engaged in reducing interest rates, certainly relative to what we've heard from the Federal Reserve.
It's a great point. The only issue with it is that so far this year, rate differentials has not been the main driver of currencies. It's been something else. It's been the sense of where you want to put your money and the sense of a trade differential and a question around U.S. assets and whether the dollar is overvalued. It has not been a story of the Fed versus the ECB.
A lot to figure out so far this morning. That's just one point. Need to get to Apple as well. We'll get to that in just a moment. Let's get to our morning calls. First up, Dan Ives of Wedbush raising his price target on Tesla to 500, saying the golden age of autonomous growth is at the EV maker's doorstep. Your second call from Adrian Yee of Barclays, lowering her price target on Ross Stores to 156, noting that fiscal 25 guidance was withdrawn despite an earnings beat. That name is down by 13% in the pre-market. And finally, Telsey Advisory Group downgrading Decker's Outdoor to market perform, noting the company's lack of visibility around tariffs. Let's stick with retail. Dana Telsey weighing in on a mixed earnings season, writing a consistent narrative across retailers and brands is that higher costs will be passed on to consumers. Dana joins us now for more. Dana, good to see you. Good morning.
Nice to see you. Thank you for having me.
Are you seeing that across the industry? Are there any bright spots where they're able to withstand this shock?
You've seen some companies being able to withstand the shock, whether it's a Ralph Lauren and a Tapestry. Brand leaders are making the difference with product innovation, but most others, the impact of tariffs is uncertain in terms of the magnitude and also the acceptance of price increases by consumers, because at the end of the day, retail is going to have to raise prices with these types of tariffs.
We were talking after Walmart released earnings and came out saying that because of tariffs, they might have to increase prices, and said maybe this gives actually a carte blanche to other companies to say, we too are getting affected by tariffs and are going to have to raise prices. Are you surprised we haven't seen that more, or that companies have been sort of chastened, in your view, by what happened subsequently with respect to a response from the president?
I think no company has the scale or the attention of the president like Walmart does. It's the biggest one out there. Most of the other companies are now saying what the impact of tariffs could be or the magnitude of what the cost will be. They're not saying what the price increase will be and how much it will be, but what they are saying is that the second half of the year, we don't know how our customer is going to react to price increases. For the most part, retailers are going to raise prices, not on every good, but on a select amount of goods. And that is drawing concern about a slowdown in terms of consumer spending in the back half, because will consumers pay or will they not pay?
Companies are spending so much time thinking about how to communicate. They're going into earnings season almost unbothered by what the numbers look like in the quarter and trying to work out how to communicate what the next quarter might look like the year ahead. Dual guidance, cut the guidance, pull the guidance, keep the guidance. Who has approached this in the optimal way from your standpoint? Who would you like to celebrate? Who do you think has done the better job this quarter?
Well, like I said, I mean, Ralph Lauren and Tapestry both have done a very good job, given they were able to talk about what's happening with their pricing now, what the consumer acceptance is. When you think who else? TJX has done a very good job also. Most companies are talking about how sales are here and now, not just the first quarter. Because to your point, it's almost like revenues and business in the first quarter is divorced from what's happening now. It's like you said, it's a week-by-week basis in terms of what's changing. More to come next week. Gap, Ulta. There's a lot more to come. Macy's in terms of what we'll see.
Consumers say they feel terrible. What are they doing?
I think consumers, for the most part, depending upon their income level, they're pulling back. They're more discerning on their spend. You're seeing it in terms of some of the data of travel and what they're not looking to do or how they're pulling back. Take a look at luxury brands. Luxury brands, except for those at the super high end, we've seen a slowdown in luxury brand spend too. So they are pulling back on their spending, also at restaurants.
You say depending on their income.
Mm-hmm.
What is the big difference right now between low-income and high-income earners and their spend? And I think what we've been tracking around this table now for years is that high-income spenders, consumers in this country, have held up well. We're trying to work out whether the stress is migrating up. You mentioned some pressure in luxury. Are you seeing signs of that?
Well, we've seen signs of pressure in luxury because of the slowdown in sales. Look at LVMH's sales, which were down low single digits. It's different than what you've seen from LVMH in the past. We've seen, for example, look at traffic to some of the different types of centers. We've seen that slow down. We've seen on grocery purchases more of an increase in some of the private label. So I've seen that change. I'll tell you, I was at a real estate conference earlier this week, and the mood is everything's good, but. The but meaning that when is the greater slowdown going to occur, and the bulk of when price increases could start sometime during the early summer.
Anyone moving production back to the U.S.?
Very hard. Can't move production back to the U.S. Too costly to make. Who has some of the greatest production in the U.S.? Bath & Body Works. Around 80% of their goods are made in the U.S.
Did not know that.
Yes.
Dana, thank you.
Thank
Appreciate
you.
the stat. Dana Tausia, the Tausia Advisory Group. Dan Ives says this on producing in the U.S. We believe the concept of Apple producing iPhones in the U.S. is a fairy tale that is not feasible.
Dan Ives has been on a roller coaster, and I am waiting for the day that he just comes in a black suit and says, I give up, I can't do it anymore. He's been both exuberant as well as depressed and despondent, saying that this is the death knell, and it seems like the moods are switching depending on the truths.
The stock is down by 4%. The latest truth from the president on Apple, that if they don't move their production, they face a tariff of at least 25%, and it must be paid by Apple to the United States. They weren't the only target for the president today. Europe, too. The president threatening 50% tariffs on the European Union. That conversation up next.
flood of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince, concerned that none of the guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
The opening bout 1 hour away. Equity futures just bouncing off session lows, still down by 1.3% on the S&P. On the Nasdaq, down by 1.7. On the Russell, we're down by 2 percentage points as the president gets busy on the iPhone, I imagine, threatening Apple and threatening the EU.
Oh, that's rich. Can you imagine? On this iPhone, I threaten you.
Oh, without a
Thank
doubt.
you.
What phone do you think he's on?
I don't know, some kind of Android. Thank you for your attention to this matter, but evidently, I really just have to emphasize, I really would be terrible at making iPhones.
What a moment going into the long weekend. You're very concerned about it.
I am.
Trying to figure out if you're more concerned about moving to New Jersey to make the iPhones or just making the iPhones.
Let's move on.
Okay. Let's get you some movers, your morning movers with Yahara. Hey, Yahara.
Hi, John. Staying on Apple, those shares are lower, more than 3% now after President Trump threatened at least a 25% tariff if its iPhones sold in the U.S. aren't made in America. He posted the warning directly to CEO Tim Cook on Truth Social, saying he doesn't want them to produce their U.S. iPhones in India or anywhere else. And I just checked, and just last month, we were reporting that Apple had the goal that by the end of next year, it was going to be producing nearly all its iPhones sold in the U.S. in India. We'll see what happens next. And next up, we do have nuclear stocks. Those are surging on reports that President Trump plans to sign executive orders to jumpstart the industry. Reuters is reporting that the president is expected to declare a national emergency over U.S. reliance on uranium coming from Russia and China. As a result, we are seeing shares of Oklo, Nano Nuclear Energy, and Centrus Energy all up. And last up, we have Booz Allen. Those shares are falling nearly 15% now. They just posted earnings. And of course, this is a government contractor and like many others has been caught in the crosshairs of this Trump administration as they seek to cut federal contracts. And it looks like those efforts are hurting the company. Revenue came in below expectations while guidance also underwhelmed. John?
Yahara, thank you. Appreciate it. Let's get back to our top story. President Trump threatening 50% tariffs on the EU starting June 1st. Joining us now from Europe, Bloomberg's Brendan Murray. Brendan, welcome back to the program, sir. Only a few hours ago, we were talking about the situation between the EU and the US. This is difficult to deal with. The president says the Europeans have been very difficult. Brendan, what is the state of play with conversations?
Well, the state of play is that neither side has agreed to the terms that the other side has put forth. So we're pretty much at loggerheads. There's going to be a phone call later today between the trade negotiating teams in Brussels and in Washington, and they're going to try to get things on track. But at the moment, the EU-U.S. trade talks are at a standstill. And you saw what the president tweeted this morning: a 50% tariff on European imports would be pretty devastating to that relationship. So don't know if that was a sort of motivational attempt for the president to try to get Europe to see things more the way he wants them to. He listed in this post on True Social the VAT tax and stiff corporate punishments and something something about monetary issues. And so kind of vague language, but pretty much of a laundry list that he wants Europe to address. And apparently, Europe's not willing to do so at this point.
Brendan, do we have a sense of what the catalyst was for this truth this morning? You talked about how it's unclear whether this is just to get some more concessions, but is there any sense of what triggered it?
Yeah, you know, you could make a case that it's this conversation that the two sides are going to have today to kind of add some fresh threats to those talks. Chinese President Xi Jinping has been calling around to European leaders this week, saying, "Hey, let's try to keep our relationships close on the economic front." So it's hard to say what the motivation was, but there was definitely a reminder this morning that the president wanted to send that he still wields this tariff threat, and he can do some economic damage with it if he follows through. Now, we've seen him make big threats like this before and pull back, so we'll have to wait and see if that's what happens in this case.
Brendan, for those following at home, do we know when that call is going to take place?
We don't know. It's sometime, before you would think in the first half of the U.S. day, given the time difference, but we don't know. Our reporters will be hitting the phones, trying to get readouts about what exactly they agree or still disagree on.
Brendan, appreciate the update. Brendan Murray there of Bloomberg, live from London, tracking this story and helping to lead our trade coverage here at Bloomberg News, trying to figure out when the timing of all this is, because a lot of people want to go away for the long weekend and they want to get past all this, don't they?
Yeah, and you raised this earlier. You said that this call between Xi Jinping and Germany maybe would raise the ire of
That's how you annoyed the
President
president.
Well, that effectively happened this morning, so I wonder how much that was part of what precipitated it. And you're right. People want this to be done so they can go away for vacation, because most people do not want the volatility to increase right ahead of a long weekend.
Not just you, all of us.
All of us.
Brendan teased it there, and I think it's important. Do you remember when Scotty B, do you remember that line in that post, was going over to Geneva, and he put out that post on social media and said, 80% tariff seems about right. And we're all sitting there thinking, okay, where's this 80% coming from? And it was to frame the negotiations going against Geneva. And I just wonder if he's doing Jameson Greer a bit of a favour here before this phone call with the Europeans.
Well, that might be one hopeful scenario, especially for people who want to go away for the long weekend and not necessarily totally rejigger their portfolios. But it does seem like he tends to take a much harsher line than the actual people on the ground who have to make the deals.
You've got to be super open-minded about this moment, as the last month has proven time and time again. Joe Davis of Vanguard joins us now for more. Joe, welcome to the programme, sir. This was snoozy going into the weekend. It was going to be a quiet one. It's not anymore. What do you make of the state of play of trade negotiations at the moment, and what do you think it means, really, more broadly, for the U.S. economy?
Well, again, thanks for having me. 2025 is feeling really like a dog year, just in terms of the uncertainty. I mean, there's a policy vortex here, and it's going to be a headwind to growth. We think this is part of negotiations. We thought we were seeing more stability in terms of the tariff rates and that they would eventually come down, which is why recession in the United States is not our baseline. But the headlines today certainly are unnerving and will continue to increase that uncertainty tax that we monitor closely.
How do you understand exactly what type of downgrade to growth we could end up seeing from tariffs? How do you sort of gauge out the magnitude of tariffs and the knock-on effect of just how much it could hit growth?
Well, you can certainly look at the drag on growth directly through the tariff rate. That could be as high as 100 basis points or 1 full percentage points if they would stick and only gradually come down. Then there's the second front, which is just the uncertainty. It's the volatility of the headlines, which can delay business investment, some consumer spending, particularly at the high end. Again, this points directly to what our market outlook was this year. We saw significant risks, particularly in the equity market, and we remain highly convicted on that view.
At this point, we've seen a real kind of increase in volatility in the bond market as people get worried about both the respective increasing prices as well as the sense that you could get an increase in the deficit. I just wonder how much you believe, as John was saying, the silver lining of this morning is that with growth concerns comes a bid into bonds, and that actually is encouraging down the line, that there still will be that relationship.
No, and again, that's actually central to our market outlook. We had almost a 20% overweight to fixed income, high quality fixed income, just given some of the downside risk we saw, particularly for U.S. equities. You could diversify outside the U.S., but it was really fixed income as a ballast, high real or inflation adjusted returns. We're having volatility at the long end, but it's still supportive of our market outlook. And again, we remain highly convicted in this volatile environment.
Joe, can we just finish on the international allocation to European equities and international equities? A lot of people have changed their mind on that. I understand that's reinforced by the price action of the last several months since the start of this year. Joe, do you see good reason for that outperformance to continue through the year, particularly given the tension between the US and the Europeans this morning?
Certainly, we have been, really of a secular view for at least 2 years that investors should be overweighting or certainly exposed to non-U.S. markets. Now, again, last year that looked out of touch, quite frankly. This year it looks prescient. But the thesis was twofold. It was U.S. valuations are too high, as well as the currency. A U.S. dollar had some downside depreciation risk. And again, we remain of that view. And, that could play out on a number of years. So effectively, our view was one of U.S. exceptionalism would get long in the tooth, and so diversify your exposure to equities. And I think we're seeing some of that play out. The volatility will go up and down on the dollar, but our view remains intact.
Joe, appreciate the update, sir. Joe Davis there of Vanguard. On the trade situation and what it all means for markets, I'm pleased to say that Russell Brownback of BlackRock is with us around the table. Russell, good morning.
Thanks for having me.
Give us the constructive view for the U.S. economy this morning.
Okay, so we have another dose of uncertainty this morning, but it's no different really from the last 3 years where we had a historic Fed tightening cycle. We had a regional banking crisis that felt scary in the moment. Last year we had a very acrimonious election, and you had these structural underpinnings in the U.S. economy where in both 2023 and 24, the economy accelerated into the fourth quarter. Now, listen, we've got some real sort of fundamental headwinds, some stagflationary kind of evolutions that at the margin will reduce growth and maybe tick inflation up a little bit. But it's far from a recession from our call. And again, underestimate these points of resiliency at your own risk.
Well, this is your point. It's really important. You believe that we are underestimating America's ability to absorb shocks. I just wonder how you're expressing that in financial markets at the moment. What are you doing?
Yep, so in our multi-sector fixed income portfolios, actually, you've probably heard Rick Reeder say, this is the golden age of fixed income. Actually, it's the golden age of income. And when you have a yield curve that's elevated and flatter than it's been historically, that front to the belly of the curve is this incredible opportunity. And then you can take what is really robust credit quality, put corporate credit, securitized assets together, and create a high-quality portfolio that yields 6.5% to 7%. And because of where you own your duration, you don't have all that volatility in the back end of the curve. So it's a super high Sharpe ratio portfolio.
Who is it income for? And I ask this at a time when a lot of people are wondering exactly who the buyer base is going to be for this fixed income, given some of the international aversion to U.S. assets.
Yep. So listen, I think the reality is we live in a world where there's too much money and not enough yielding assets. So there's $25 trillion of cash on the balance sheet of the private sector. That's more than all marketable treasury debt. There's $220 trillion of private sector net worth. So when you think about the size of the global or the U.S. aggregate index at about 50 trillion, there's a reason credit spreads are as tight as they are. There's a wall of money that needs yield today. And when you think about the demographic trends and the increase in savers, this narrative that we're on the brink of not having enough wherewithal to finance our debt is far from reality.
Okay, but given that, where is this wall of money going at times when you've got bond yields rising, you've got stocks selling off, and you've got the dollar weakening?
Okay, so 70% of marketable treasury debt comes due in the next 5 years. Every point on the yield curve 5 years and in trades at negative carry to cash, to the overnight rate. So where's the outrage? Honestly, that's a picture of more money than there are investable assets today.
So this raises a question going forward. Is this a bet that can get carried over to duration? You said that this was something that you were avoiding. Is it basically that you see that as the riskiest period right now, the idea of that 30-year or 20-year treasury that isn't very predictable?
It's really a matter of valuation. So, actually, at the long end of the curve, when you've got the long bond at 5% and corporate bonds, high-quality corporate bonds at 6%, that's a really nice environment if you're a long-duration buyer like an insurance company. or a pension fund. For us, you don't really get compensated for the implied volatility of being out the curve. So the sweet spot is to be in the front of the belly where you get almost all of that yield without all that implied volatility. For a 60-40 portfolio, for the 40 for your fixed income part, you use that optimized expression that I just described, and then you marry it with equities.
Russell, looking at the spread right now between the supposed risk-free asset and credit at the moment, it's really tight. We were talking about Michael Hartnett of Bank of America this morning about how tight Microsoft was trading to the government bond, to treasuries. And in some maturities, trading through it at the very front end of the curve. Typically, we'd say that was a lot of confidence about corporate America. That's why spreads are so tight. But this time around, people are saying it's the opposite. They're saying there's a lot of fear about treasuries and whether the US government is trading as a credit. You push back a little bit against that. Could you explain that a little bit more about what people are getting so wrong?
Yep, so I think the risk-free curve is in equilibrium. It's twist-steepened since the election. I don't have my terminal in front of me today, but we were 444 on election day. I'm guessing we're right about there now. Front end's lower, back end's higher. Curves evolved in a stagflationary outcome. That makes sense to me.
That's what you think this is, a stagflationary shock going through the yield curve?
Yeah, a modest one, and that's what's reflected since election day. But as it pertains to spreads, so yeah, credit spreads are tight. I get asked that in every client meeting I go into today, but there's three reasons. One, credit quality is pristine across investment grade and certainly in the higher part of the high yield market. Second, people don't buy spreads, they buy all-in yields. And third, think about the technicals. There's some amazing statistics. So 20 years ago, the investment grade index and the treasury index were the same market cap. Today, the investment grade index is about half the size because the treasury market is growing more quickly. And the high yield market, 1.4 trillion in total market cap. The treasury market grows by that size every 9 months. So there's a relative scarcity of these credit assets today, and that's why spreads are tight and will probably remain so.
Do you expect spreads to tighten even more as companies refrain from issuing more debt at a time when yields are this high, given the fact that there is uncertainty and some of the CapEx plans might be put on hold, or M&A and other things that would require them to raise money?
Yeah, we've seen a pretty normal issuance patterns so far this year, and you definitely see a pullback when rates back up, and then they sort of reaccelerate when rates drop. So I see very normal behavior from issuers today.
You said something before that I thought was really interesting, that if you wanted to buy long duration bonds, you'd barbell it with stocks. You'd have this sort of barbell approach at a time when both are considered risky for different reasons. Are you believing that in some sort of downturn, that U.S. Treasuries will ultimately, to John's point, have the same function that they always have in terms of rallying and providing that ballast?
Absolutely, 100%. I mean, when you think about perhaps at this moment, I think the worry is around deficits, which are clearly on an unsustainable path. What is the next move if there were a shock, heaven forbid, another pandemic, where you needed a multi-trillion-dollar fiscal package? The good news is, in this instance, there's hundreds of basis points for the Fed to cut, and they could restart QE if they needed to. So there's lots of ammunition, and the front end of the curve would absolutely respond to that easing of policy. And again, if you own your duration in the front of the belly, the curve's going to steepen, and that's going to work for you.
Final question. The point of asset scarcity, which runs right the way through this conversation, does China and Germany have something to say about that? Or Japan and Germany, rather, have something to say about that?
Well, I think this notion of U.S. exceptionalism being over is a narrative. I don't buy it. I mean, I think if you want real equity returns, look at the S&P 500 has an average return on equity of about 18%. Even the equal-weighted S&P, about 12%. So even for the equal-weighted S&P, you can double your book value over 6 years. The returns are exceptional.
That's the equity story, but you were talking about the bond market with regards to asset scarcity, supporting fixed income. And what we see taking place in Japan might upend some of that. Taking place in Germany in years to come might upend some of that. How does that factor in to your thesis?
So I think the ubiquity of U.S. Debt and the size and depth and liquidity of U.S. markets are really unparalleled. There is no substitute. So the U.S. municipal bond market, in terms of its capitalization, is bigger than the German Bund market. I mean, there's just not really a whole lot of alternative.
Russell, this was great. I could talk to you all day about this. Rick is banned from this show from now on.
No way.
Just want to speak to Russell Brown back at BlackRock.
No way.
You're trying to create dissent back in the ranks at BlackRock?
Rick's never banned, don't worry.
I learned everything I know from Rick.
He's the best. I love Rick too. He just doesn't wake up early enough to come on this program anymore. Let's give an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahara. Hey, Yahara.
Hi, John. President Donald Trump delivering a new slate of tariff threats this morning. He's taking aim at the European Union, Posting on Truth Social, he recommends a straight 50% tariff on the EU starting on June 1st. European stocks are weakening as a result. And here's the next one. President Trump also threatening Apple with tariffs, writing on Truth Social, "I expect their iPhones that will be sold in the United States will be manufactured and built in the United States. If that's not the case, a tariff of at least 25% must be paid." Shares of Apple also falling 3.2% as a result. And Harvard just said it is suing the Trump administration over its move to block it from enrolling international students. The university saying the Department of Homeland Security violated its First Amendment and due process rights. Just yesterday, the Trump administration revoked Harvard's certification to enroll international students, saying it fostered an unsafe campus. That's your Bloomberg Brief. John?
Yahara, thank you. Thanks for this morning. Have a great weekend. Up next on the program, we'll set you up for next week, and we'll touch base with Tyler Kendall in Washington for the latest social media post from the President of the United States.
The President of the United States does say he wants to keep a more mutually beneficial trade balance with these countries. What does a country like Egypt and Kenya and some of these others have to provide that won't completely dent their own GDP?
No, it's tough. I mean, there is the commodity side. There is the. I think it's less about bringing it to the table and more trying to take advantage of the hit elsewhere. So China exports 30% of all the textile exports to America come from China. In 2023, it's something like $40 billion. And whatever the tariff rate ends up being on China, it's going to be a lot higher than it is on Africa. So there might be scope for African countries to say, well, let's move those textile factories.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
The opening bell is 38 minutes away, and equities are just off session lows. We're down by 1.3% on the S&P, and the Nasdaq 100 negative by 1.7 as we count you down to that opening bell. Let's get to the trading diary. The calendar looks like this. At 2 p.m., the U.S. Treasury market closing early for the long weekend, so enjoy that. Of course, we are closed on Monday for Memorial Day. As we wake up to Tuesday morning, look out for durable goods. Wednesday, NVIDIA earnings and Fed minutes. Thursday, another round of jobless claims. And next Friday, PCE and UMich consumer sentiment. Now, by the time we get to Friday, I've got absolutely no idea what we'll be focused on because we flipped from tariffs to taxes, and this morning, back to tariffs again. Tyler Kendall joined us now from the nation's capital for more. Tyler, this call that's going to take place between the Europeans and Jameson Greer, USTR, is going to be very interesting later on today.
Yeah, hey, John, really closely watched, and it seems that this Truth Social post from President Trump will be setting the tone ahead of it, as President Trump says that there has been no progress made when it comes to talks with the European Union. Now, Bloomberg News had reported earlier this week that the EU did float to the U.S. this updated proposal that could have seen both sides gradually lowering their tariffs down to zero on some agricultural goods and industrial goods, but appears that was not enough to move the needle in these negotiations. And we've been talking about it a lot on this program, but there's a few different complicating factors here, including that all the EU member states have to is really focusing in on, with President Trump talking about value-added taxes and historically how the digital services taxes could play into this conversation.
Tyler Kendall, looking forward to your reporting. Thanks for this morning. And have a great long weekend as well. Tyler Kendall there down in Washington, D.C. on the latest trade effort. I think we have to acknowledge that this is part of framing the talks between the U.S. and Europeans a little bit later on today when they held that phone call. But I think we also have to acknowledge that this underscores the difficulties that the Europeans are having right now trying to negotiate with the U.S. There's been signs building now for a number of weeks that the U.S. was unhappy with the Europeans.
And it's not just because of tariffs, because we've heard from European trade representatives that they'd be willing to drop their tariffs to zero in return for the same from the United States, but it has to do with these non-tariff barriers like the VAT tax and some of the other restrictions around companies, and that's actually going to be a much harder sticking point. I do wonder if this uncertainty is going to take a real toll on economic activity. Torsten Slok just putting out a chart saying that even after the truce between U.S. and China, you have not seen trade really come back. The container ships are not leaving in greater numbers from China. It just highlights some of the concerns here about the economic blowback.
Lots of guests have come on this program, even this morning, and made the argument we're past peak tariff uncertainty. You and I both sat here and said, well, we haven't seen the damage. We haven't seen it hit the economic data just yet, and that still might be just around the corner in the months to come.
Because the uncertainty is still there, at least for companies, and they're taking action as a result. Question is, how do markets respond to some sort of negative economic data, and how significant is it, right? If it's not recession, is it fine? At what point is it not okay? At what point does it become stagflation? And these are the questions that people are trying to parse through at a time where there's almost like a blunt instrument. Recession bad, anything else is good, and it's not clear that that's exactly the case.
And where will we see that damage first? So many people have spent so much time talking about it potentially happening in America. What about Europe? What about China? What about the European economy?
Which was the initial belief coming into this year, that the other economies, ex-US, would be hit much harder than the United States. And then in markets, that was totally flipped on its head. When we start to see some of the ramifications come through, you know, could we be in for another reversal?
We've made it. You happy?
Well, you didn't make it any easier.
We've made it.
Yeah, you were like, oh,
long weekend just around the corner.
Day.
Coming up on Tuesday, Steve Chevron of Federated. It's quiet. Tom Forty of Maxim Group, Nicey Group President Lynn Martin, Amanda Lynham of BlackRock. To all of you worldwide, have a wonderful weekend. And if you get a long weekend, have a very restful one. From New York City, thank you for choosing Bloomberg TV. This was Bloomberg Surveillance. It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise.
With some fun along the way.
This is Bloomberg Surveillance.
How much does the geopolitical volatility emanating from the United States perhaps undermine the bull case for Mexico? Is that a scenario you've plotted out?
Structurally speaking, we do still have a very positive view in Mexico. On the macro side, it is a very attractive investment geography for the U.S. Mexico is hugely competitive in terms of costs. The wages in Mexico are much more competitive than the wages in China. So why would the U.S. companies not take advantage of that?
And this structural cost advantage is going to lead Mexico to continue to contribute to the growth of U.S. as well. The value chains, the supply chains are so integrated that Mexico has to play a continuing role in the further development of the U.S. And U.S. is growing very healthily, very nicely. It will benefit Mexico this way or that way. It will benefit Mexico.
Mexico for BBVA is, a source of resiliency of earnings, and it generates, complements the diversification that we have from the footprint. But there's another topic that is very important, which sometimes we don't focus a lot about, and why we're so convinced that Mexico is going to continue to do well, which is the leverage in the country. Because the leverage in the country is only 33%. And when you've seen Mexico grow and BBVA grow in Mexico, structurally speaking, the leverage is so low that just a little bit of growth in the leverage is going to be able to support that bull case in Mexico. So that's why we're structurally positive in Mexico.
In case you missed it on Balance of Power.
If we're going to get all this revenue from tariffs, why would the president be pushing for higher taxes on anybody? Because our understanding is for the wealthy, he's looking at a new rate of 39.6%. And I thought the Republican Party didn't stand for that kind of thing.
Well, you realize that the tariff revenues doesn't count toward the reconciliation numbers. Don't ask why. I can't understand why. We're running at like 20, 25 billion a month. And they're not counting it, but we'll leave that aside for another day. This is Washington. They have their own accounting practices. So the president's trying to make sure he gets no tax on tips, no tax on overtime, and no tax on Social Security. And if he says, look, the richest Americans, remember, he cut it from 39.6 to 37. So if he just goes back to what he did last time, I'm in favor of that. I think it's smart.
Don't miss Balance of Power live every weekday.
Up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
All right, a tariff-driven sell-off, 30 minutes until the start of trading. I'm Matt Miller.
And I'm Danny Berger. Katie Greifeld and Sonali Basak are off today. Bloomberg Open Interest starts right now.
Coming up, tariff threats. President Trump announces a 50% tariff on EU goods starting June 1st. And the president targets Apple again, threatening a tariff of 25% if iPhones sold in the U.S. are not made here, which would be obviously very few. Plus, these threats fueling a fresh sell-off as the S&P heads for its worst week since the start of April, since Liberation Day, Danny Berger.
Goodbye any hopes you had of a quiet Friday ahead of the long weekend. Here we are, one of the stocks to watch, as Matt mentioned. Apple facing more pressure, down 3.25% from Trump, facing that pressure of more tariffs, with analyst Dan Ives saying made in America iPhones would triple the price.
Triple the price. Not of the stock.
No, of the iPhone.
Of the iPhone.
$3,500, something like that for your iPhone.
Whatever, we can afford it, I guess, if it's paid on a monthly basis. Retailers are falling after pulling guidance on macro uncertainty, which stems from Trump's tariff barrage. You can see Ross Stores right now down 14%, and Deckers Outdoors, which makes Uggs and Hokas, losing a fifth of its value, Danny.
Matt Miller not buying enough Uggs to support Deckers. All right, back to our top story. This weekend marks the halfway point of President Trump's 90-day pause on tariffs in order to strike deals. Now, while trade negotiations are underway with several countries, Trump has signaled that talks won't lead to agreements for every nation before the July deadline. And this morning, he said that the European Union talks are going nowhere and will implement a 50% tariff on the bloc starting Sunday. Bloomberg political reporter Tyler Kendall joins us now from the White House. Tyler, we are supposed to have negotiations with Jameson Greer and his counterpart in the EU. How does this set the scene?
Yeah, hey, Danny, it's definitely setting the tone ahead of those planned talks that were still expected to happen between the EU's trade chief and USTR Jameson Greer later this afternoon, as President Trump says that ultimately there's been no progress made when it comes to talks with the European Union. Now, we should note that Bloomberg News has been reported reporting that the EU floated to the U.S. earlier this week a revised proposal that would see both countries gradually lowering their tariffs down to zero on certain agricultural products and industrial goods. It does not appear that that was enough to move the needle in any way for the U.S. And of course, as we've been, discussing on Bloomberg Television, there's a lot of different complicating factors here when it comes to striking a deal with the EU, including that they are negotiating as a bloc, so all 27 member states have to agree on the ultimate end goal here. And that can make things particularly complicated when it comes to addressing some of the White House's top priorities, like those non-tariff barriers that they talk about, such as the VAT tax or digital services taxes.
Right. We should be clear and point out that the VAT tax is in no way a non-tariff barrier because, and I'm not sure if anyone's explained this to President Trump, European manufacturers pay the VAT tax as well. So that would be like calling New York State sales tax non-tariff barrier. Everyone has to pay that. It's just a simple tax on sales, which is like what we have here in almost every state. In terms of the 50% tariff that Trump wants to put on, he says June 1st. Does that mean it's going to happen, or is this just leverage for talks?
Yeah, well, Matt, as you know, of course, there is so much uncertainty as always, particularly when it comes to that timeline. We're going to have to see how the EU ends up responding to that threat. As you know, they had some planned retaliation worth about $107 billion in response to the sector-specific tariffs that have gone into place and have hit the European Union particularly hard, like steel and aluminum and also autos. And they were gearing that towards some of those key U.S. industries that President Trump has sought to protect, like U.S. agriculture. So that's going to be a very key sticking point here, whether or not there's some sort of threshold here where the U.S. would potentially back off of this tariff threat.
All right, Tyler, thanks very much. Bloomberg's Tyler Kendall reporting live from the White House. I should point out there are 5 states without a statewide sales tax.
Is Delaware one of them?
I think Delaware is one. Yeah, Alaska, Delaware, Montana, New Hampshire, and Oregon. But even in those states, you may have a local sales tax, like a city sales tax. So if you're charging VAT in, for example, Germany, BMW, if you buy a BMW made in Germany, you have to pay VAT. If you buy a Porsche made in Germany, you have to pay a VAT. So anyway, just to clear that up, and if anyone's listening from the White House, that's not a non-tariff barrier. Later this morning, Bloomberg is going to sit down with Treasury Secretary Scott Bessent. Maybe David Weston will whisper this in his ear as well. That's at 11:30 a.m. New York time. Let's get more details on the Apple story that we were talking about. Analyst Dan Ives says Made in America iPhones would force Apple to charge more than $3,000. And then, of course, in New York, you'd have to pay the extra
sales tax.
Or if you buy
sales
it tax.
If you buy it from the EU, then you got to pay a VAT tax too.
Another 20% there. Bloomberg technology co-host Caroline Hyde joins us now to talk about this. So, President Trump had given Tim Apple a reprieve, and now he's saying, look, you got to make these iPhones here.
And it wasn't even a reprieve for long, because we've heard him being the line of fire for the last week or so, calling out Tim Cook not being there in Saudi Arabia, remember? Saying he had a little problem with Tim Cook about the amount of manufacturing that was shifting to India. And now he puts it plain and clear on his own social media account, saying you will be charged 25% tariff if you don't start moving your manufacturing to the United States. Enough is enough, but you just had Dan Ives saying, look, this is how much it's going to cost to build an iPhone in the US. They're calling it a fairy tale. They're calling it frustrating. You've got absurd being words thrown around by the analysts at the moment. This is going to be a big stomach cost in terms of margins. Whether they're paying the 25% tariff to import them from China or India, well, that's going to be about a margin hit of 300 to 350 basis points, so says Bloomberg Intelligence. And more broadly, this is impossible in the next 3 to 5 years. You need the labor, you need the skills, you need the ecosystem. This is going to be some tough negotiating for Tim Cook, who is very political in many ways himself.
Which, by the way, if it's 3 to 5 years, who's to say Trump is even the president by the time that they achieve that goal? And doesn't this come at the worst time? Hasn't the FT just been reporting that they were doubling down on moving production to India?
And maybe that's what sparked the anger coming from the Trump administration, that even though he singled out Tim Cook for putting all the manufacturing in India. It seems as though they're still going ahead with it. They need to go ahead with it because they need to diversify. This hasn't been overnight that they've shifted to India. This has been years, decade in the making, going from China to ensure that they can build in Vietnam, in Thailand for your AirPods, make phones in India, but they've had to build up the ecosystem of suppliers. This is why you're seeing the suppliers get hit, as well as Apple in pre-market trading, because they're ultimately worried about how hard this is to navigate this to the United States, to get the right labor force, and ultimately the amount of price points that we're going to drive up. But at the moment, they had been doubling down on India manufacturing because it looked as though tariffs were likely to be lower in the longer term from India shipping to the United States. That's a lot of phones they're going to have to make in the United States, and that's going to cost a lot of money.
We're going to start to see those memes again of everyone in their Wall Street vests at the factory making the iPhones.
I can't wait for my daughter to get a job in the iPhone assembly factory.
So your daughter should study engineering, so not the worst idea. Caroline, thank you so much. Bloomberg Technologies, Caroline Hyde. All right, let's look at some earnings that we've got, because that's making waves too. Retailers, Ross Stores, and Deckers, not putting this out, both falling after the companies pulled their full-year guidance due to macro uncertainty. Dana Tesley of the Tesley Advisory Group downgraded Deckers today. She spoke to Bloomberg earlier this morning.
You've seen some companies being able to withstand the shock, whether it's a Ralph Lauren and a Tapestry. Brand leaders are making the difference with product innovation, but most others, the impact of tariffs is uncertain in terms of the magnitude and also the acceptance of price increases by consumers, because at the end of the day, retail is going to have to raise prices with these types of tariffs.
For more on retail, we are joined by Bloomberg earnings specialist Red Brown. Great to see you this morning. Look, it's not all retailers that have reported negative earnings. Some, like Walmart, still have strong demand. How much of this is a Deckers and Ross problem versus a consumer problem?
Yeah, no, that's a great point. Some analysts this morning actually pointing to Deckers might actually be just shifting into kind of a lower growth period for the company. You know, Hoka and Uggs have been big winners over the last couple of years. You know, you see them on everyone's feet, really, when you're walking around the city here. But it just might be kind of bad timing for them to kind of be decelerating just slightly.
In terms of eating the tariffs, which is what President Trump wants these retailers to do, how fat are their margins? I mean, when you look across the earnings spectrum, and I know you cover a wide range of industries, but retailers, what are they making, and how many can really afford to eat up these tariffs?
Well, they're typically operating at much lower margins than maybe, like, you know, obviously software companies, things like that. You know, Ross is around like 25–30%, for example. But again, think about who their customers are. For Ross Stores, they have their other brand is called DD Discount, right? So it's people that are looking for to get high quality goods, but they're looking to do so at a much lower price point. So these aren't people that are going to be, these are people who are particularly sensitive to price increases. So not working with a lot of leverage at the moment.
Well, the phrase that Matt said, eat the tariffs, came directly from President Trump, directly after we got those Walmart earnings. When we hear from these companies, how difficult is it for them to navigate when they know that their earnings call might be dissected by the leader of the free world and might get a direct response to it?
Yeah, right. No, you know, everyone's talking about uncertainty, right? But I think we got a great example of it today. Like when we say uncertainty, it's a tweet, it's a post, it's whatever, what have you. So yeah, you know, they're having a very difficult time navigating just like the PR of what is correct to say, what can I say without getting a really harsh backlash. So yeah, definitely difficult waters to navigate.
All right, Red, thanks very much. Red Brown covers earnings for us on the BN side. I should point out, Dana, that our producers in the control room have done some research. I always kind of joke about my 4-year-old daughter one day putting iPhones together, but it's not a bad salary. Apparently, Indeed.com has listings in Cupertino, California, $154,000 a year for Apple assembly technician. That's a pretty decent pay package, and I'm sure it comes with healthcare as well.
I'm sure this country needs more of it. Part of the issue is that we've ceded all of that specialty to China. We don't have those specialized types of engineer, not just for literally assembling them, but the types of equipment that need to be made. So I think it is a valiant career path, Matt.
All right, let's take a look at futures right now. In terms of the S&P 500, we saw a huge drop, about 1% and change essentially when we got this second Trump tweet on tariffs, the EU 50% threat. Right now we're looking at a 1.5% drop, about 83 points to 57.70. Now this is the futures, but if you're looking at the cash trade and we drop below 57.70, that would be a drop below the 200-day moving average. The NASDAQ futures down almost 1.8%. Obviously, this affects the tech stocks more seriously because of the Apple threat, and then Russell 2000 off 2% and change. Coming up, Tesla upgraded on Musk's dedication to the company and potential for autonomous products, especially humanoid robots. This is Open Interest. Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
What is the issue between the type of information that's being collected by investors and the marking issue that you're describing?
What mark-to-market assets do is it forces honesty into the situation. We're talking right after the DeepSeek model surprised everybody in its efficiency. It took hundreds of billions off of market caps because it legitimately raised concerns that maybe the future of AI was different. I guarantee you that if you look at other portfolios that aren't marked, they didn't move. If private assets are going to eat the world, as they say, with the equity market halving in the number of names, you come to a world that is increasingly an echo chamber. Imagine you have a firm that has some public assets and some private assets. If you see your public assets in AI going down by 20%, you're going to be thinking very, very deeply about what your private assets are worth differently than someone who just has the latter.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Let's get now to high interest and look at what's making headlines around the world. Nuclear power stocks are rallying after a report that President Trump will sign executive orders that ease regulations for the sector. The report indicated that Trump will invoke the Cold War-era Defense Production Act to declare a national emergency over U.S. dependence on Russia and China for raw materials used for nuclear energy. And the Trump administration has blocked Harvard from enrolling international students. The move delivers a major blow to the school and escalates its fight with elite colleges, the administration's fight with elite colleges. Existing international students must transfer or lose their legal status, according to the Department of Homeland Security. And by the way, that's 27% of Harvard's student body. The blockade will increase financial pressure on Harvard, which has already had $2.6 billion in funding frozen and faces the loss of its tax-exempt status. Harvard obviously is calling this ban unlawful and is suing. OnlyFans owner Phoenix International is in talks to sell the company to an investor group at a valuation of around $8 billion. The London-based company, which hosts pornographic content forbidden on many other social networks, is reviewing a number of offers. According to Bloomberg sources, any deal for the website will have to overcome risks associated with hosting adult content, but they're trying to broaden it out. to the mainstream. And Tesla bull Dan Ives is rallying up the herd. The Wedbush analyst raised his price target to $150, a new street high of, $500. That's his new price target, a new street high it would be. In a note this morning, he wrote, "We believe the golden age of autonomous is now on the doorstep for Tesla, centered around the success of its autonomous vision taking hold." The stock, however, is caught in this morning's sell-off. And joining us with more is Bloomberg's Detroit bureau chief, David Welch. So, David, what do we know about the drive for the stock valuation of Tesla? Because as Elon Musk told our Michal Hussein the other day, it's more than $1 trillion in total market cap. Is that driven by just making cars?
No, it can't be. First of all, the margins for making cars are just not that great. Tesla's growth is no longer there, right? They've got more competition in China. BYD has overtaken them. Sales down in Europe for a variety of reasons, partly competition, partly Elon Musk's politics. And, the company's struggling to maintain market share in the U.S., where you've got Hyundai, General Motors, and others selling more EVs now. Cadillac saying they're picking up some Tesla trade-ins these days. So he's not going to get growth just in the vehicles. And look, I love what we're seeing this morning with Ives' report, and then the fact that the shares aren't really reacting to it, because it shows you the entrenched sides of the Tesla bet. So Dan Ives is all in on the AI and autonomy bet, saying that they're going to get $1 trillion in value to Tesla alone for self-driving vehicles, robotics, AI. Market's not quite buying it yet. We'll see in June when Tesla really gets these vehicles out in Austin in earnest. But Waymo has been running self-driving vehicles on public roads and working on them for 15 years. Well, not all of that on public roads, but for a very, very long time. And they are very slowly, methodically moving into their 6th city. And so, they're not blitzing this thing because it's a very difficult problem to solve. Tesla's been running partially self-driving vehicles with autopilot and FSD, but those aren't truly autonomous systems. They're really driver assist that they've been running for most of the time.
Beyond the technology too, the thing that's really taken Tesla lower in the pre-market, which you can see that, was Trump's tweet about tariffs. It wasn't anything about the company specifically. It also comes as a time when BYD finally, for the first time, surpassed Tesla sales in Europe. Does Tesla have a brand problem still, even with Elon Musk saying that he's pulling back from politics?
Well, they do. Look, there are a couple of heroic assumptions in Dan Ives' report. One is the $1 trillion for autonomy, but the other is that once Elon Musk leaves the Trump administration, or if he spends more time at Tesla, that the brand problem goes away. It doesn't. Look, his politics are pretty conservative, and that's his choice. I'm not making a judgment on that. But he routinely espouses that on X. So people who aren't going to buy his cars because of the politics, this brand issue that analysts have talked about, that's not going away because Elon is who he is and he believes what he believes. And if people don't like that, they may not buy his cars. So yes, you're right. I mean, you do have this issue on the vehicle side. But the main thing driving the Wedbush upgrade on Tesla is this autonomy bet. A lot of people have lost money going against Elon, but cashing in on autonomy is very difficult to do. It's always taken longer than everybody has thought. We were supposed to have self-driving cars all over the roads in 2020. It didn't happen. A lot of companies went bankrupt. So there's a big show-me aspect to Tesla and autonomous vehicles and AI.
I will say that I mean, not completely self-driving, but in a lot of the cars I test out, they do drive themselves for the most part, right, on big highway runs. General Motors has a system for that. I think Blue Cruise, Ford does as well. What about the robots, David? How important are the robots going to be for Tesla?
Look, I think it's a piece of this. They've talked less about it because we don't really know when they would come to a period where they're monetizing that, right? Elon has shown some interesting things on X that are kind of a lot of fun, and they served drinks at the event last year. But are they going to be getting to a point soon where that's a revenue and profitable part of their business? But look, it's all part of Elon's push that this is a technology company. It's not just a car company. And whether or not you think the stock's going to go to $500, like Dan Ives is saying, is whether or not you believe that argument. And I think that's the battleground on Tesla shares at the moment.
Hey, David, thank you so much for that update. That is Bloomberg's David Welch. Now, coming up, we get back to a market that's falling after more tariffs, or the threat of tariffs being announced by President Trump. Citi's Kate Moore argues that the S&P 500 is fairly valued now. She joins us next. This is Bloomberg Open Interest.
Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, is emissions.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Asia is at the forefront of some of the world's biggest stories. I'm Chevrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
A few minutes ago into the open, equity futures falling this morning after a 1-2 punch. First, a President Truth social post about Apple threatening tariffs, and then to the EU threatening 50%. Citi Wealth Chief Investment Officer Kate Moore joins us now at the desk. And Kate, I just want to flag Scott Besson speaking to American media moments ago, saying that he hopes that the Trump EU threat would light a fire under the EU. When you look at these sorts of things, is it a negotiating tactic, or do you assume that these levels are coming?
I think we should assume, and let me just start back and say, I think many people in the market assume that 10% was the level that we were going to arrive at by the time we get to September, and that these reciprocal tariffs were not going to be a major issue. I think we should assume that ongoing tariff negotiations and threats are going to be the rule, not the exception. And so whether we're talking about Europe specifically, or China, or other countries, or very specific goods or companies, I don't think we're going to get past the point of pain by the time we get to Labor Day, which in my view was sort of being priced into markets.
Isn't this, I mean, just a continued gift to China and Russia? The fact that he causes this kind of global trade disruption for us makes them turn to them?
Yeah, it's certainly going to accelerate the realignment of alliances, of global trade, and relationships in a way that we would maybe not have forecast at the beginning of this year. I think what's going to be really important is to watch is that China needs to deal with a bunch of domestic policy as well, like how much stimulus they want to give to the consumer, what do they want to do to kind of increase confidence for foreign investors looking at investing in Chinese stocks, but also critically, how much do they then want to spend outside of China to deepen these relationships, which we've seen them do in other points of crisis in the past, right? Whether it's securing resources, whether it's securing supply chains, whether it's partnering with local governments. So I'm going to be watching Chinese policy very closely over the balance of this year.
All right, Kate, we're going to keep you with us. Citi's Kate Moore stays with us through the open. We're going to ask her what she thinks of valuations even at these levels. And we could see the S&P 500, by the way, fall below the 200-day moving average. We are back with the opening bell next. This is Bloomberg.
In this facility, which is part of your $2 billion investment in the last 2 years, it's a massive amount.
Yes, because, we've focused a lot on automation and upgrading our quality standards so that we can adhere to the US FDA and European standards, because some of our vaccines now are going even to the West, which is a fundamental shift in our strategy, from back in the day when my father started the business, where we were predominantly in India and the developing
India-centric, now you're more global.
Yes.
So you're about 8,000 strong in this
Yes.
facility? All Indian nationals?
Mostly Indian, yes. I would say 99% of talent that we've trained overseas and in India. We have our own internal skill building center where we train on site.
Serum started with just producing vaccine for tetanus, but it's producing a lot more vaccines now. What is the next big thing you think?
A global pandemic flu vaccine is something that we're working on, and I think the world will need that, not only for the annual flu cases, but God forbid there's a flu pandemic. I think we are very well poised to make 1.5, 2 billion doses and roll it out very quickly to protect the world. And we have, of course, the other vaccines, as we talked about, HPV and malaria, that we've just launched, and we're going to scale that up as well.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
We are moments away from the start of trade on what looked like was going to be a pretty boring Friday. Well, it's not. Donald Trump took care of that for us. S&P futures down 1.25%. NASDAQ futures off 1.5% after he tweets out or truths out that Apple may face a 25% tariff and the EU may face a 50% tariff on all of its goods starting June 1st. You hear the opening bell on New York Stock Exchange. I believe, once again, it is the United States Navy ringing the opening bell. Great to have these guys here. If you've never been to New York during Fleet Week, it's awesome. You've got so many sailors walking around, and you can thank them for their service. Also, I'm excited about sailing because of that dude who's sailing from Oregon to Washington with his cat. We're going to talk about that later. You've got some sort of SPAC ringing the opening bell on the NASDAQ. No one cares. In terms of the stocks to watch, obviously Apple is a huge one today because of that truth.
I was also just thinking, do you think a lot of people just aren't at the office today because it's Memorial Day weekend, and then all of a sudden you have all of this to deal with?
Yes.
Probably the worst time if you're at a beach somewhere. Apologies to you. You're probably logging onto your terminal now. As Matt mentioned, Apple down 3% after the opening bell, facing pressure from Trump. He wants iPhones made in America, just as Apple reportedly was doubling down on manufacturing in India. He says, make it in America, Matt, or he's going to put a 25% tariff on the company.
Yeah, it'll be interesting to see how many iPhones are made in America, assembled in America, right, by the end of this term. Something we've been talking about a lot on this program. Retailers are falling today after pulling guidance on macro uncertainty. This has really been a trend throughout earnings season. They say macro uncertainty, global trade uncertainty. What they mean, obviously, is tariffs. And as you can see, Ross Stores getting absolutely decimated, and Deckers Outdoor, the maker of Uggs and Hoka shoes, double that. So big drops after tariff threats or even the result of tariffs hurts the actual earnings outlook. Let's talk about that with Citi Wealth CIO Kate Moore. She's back here with us at the desk. And Kate, you know, this is all about stocks are a discounting mechanism, right? You're saying with the S&P trading at 23 times forward earnings, we believe that the market is more than fairly priced. And I have to say, especially since we don't really know what forward earnings are, right? Everyone's pulling their forecast.
Yeah, everyone's pulling their forecast. Actually, I just had a flashback a moment ago to the last time I was on this show. We were talking about pulling forward of demand. And I had mentioned that I pre-ordered a bunch of running shoes with the expectation that the prices for those were going to go up. So I have to say, I'm not surprised that we're seeing some of these consumer companies pull their guidance for
Are you a
the second
Hoka
half.
runner?
Yeah, I'm a Hoka runner, right. Yeah,
Okay.
I have an incredible stable of Hokas.
Nice.
Let's put it that way. But I think, you know, when I go back to this earnings story, you know, we've seen a large number of cuts from analysts, but the magnitude of those cuts is not very big. It's like death by 1,000 paper cuts. They want to signal that they know that they're headwinds, but they're not doing anything substantial because the uncertainty factor is so high. Are we at 10% tariffs? Are we at 25% tariffs? Does demand crater? You know, do taxes change people's consumption patterns? You know, no one really knows. And as a result, it's hard to say that when we look at forward earnings, forward multiples, that they make sense.
Not to mention, Matt and I were talking about this earlier, if you're a company, if you're Walmart and you say, maybe I need to raise prices, you could get a Truth Social tweet, post, whatever, from the president saying you have to eat the tariffs. You could be Apple getting a message also from the president saying you need to bring manufacturing in the U.S. Just how difficult and unprecedented is this for companies to navigate right now?
I think it's incredibly difficult. Another area I'm watching actually is in terms of the labor force. You know, we've seen very few firings or mass layoffs. People trim a little bit on the margins. There's a lot more sort of quiet trimming of labor force, but sort of the loud ones that we might see if people have expectations for slower growth, even tariffs accepted, you know, haven't happened yet. I suspect some of that is because, number one, it is very expensive to rehire people if your forward estimates of growth are wrong. And number two, because no one really wants to catch the eye of the administration. They'd like to be as much BAU, as business as usual, as they possibly can. And so, I mean, I think there are lots of sort of behaviors that look a little bit different in 2025, given where we are in politics and policy.
I wonder when we see these kind of tweet barrages, and frankly, we see them every day. So it's not like the president has a strategy to change the news flow, but he does. Yesterday, we were so focused on one big, beautiful bill and the resultant deficits, right? We're expecting them to add $5.5 trillion to our already way too big national debt over the next 10 years. How much does that, I mean, to go back to that issue, how much does that matter to your, to the work that you do at Citi, you know, to your modeling, to these companies that you're looking at?
It matters a huge amount. I will say, in general, it feels like the market only pays attention to one thing at a time. And so today, it's tariffs, right? But yesterday, it was what is going to be the impact in terms of the overall deficit? What does this do to bond yields? But for us as multi-asset class investors and trying to invest our clients' money and advise all of our clients' portfolios, you know, we're asking this question, which I think is a fair question. What is the balance? What is the hedge? What is the ballast? You know, if bonds are, you know, being impacted by one set of policies and equities are being impacted by another, and sometimes the correlation goes back to one, you know, how do you construct a well-balanced portfolio that can manage risk? And I think as I talk to other asset allocators and other types of CIOs, you know, on the street, we're all having similar debates, if I'm honest. And this is something I think we're going to be doing a lot more work on. But right now, duration, which has historically been a great balance and a great hedge for portfolios, doesn't feel that way.
We're not experiencing the kind of drops that we saw in futures, right, in the cash trade. Just to look at the market right now for a minute, we don't see the S&P 500 down more than 1%. We do, however, see yields coming back up. You know, yields had been diving this morning.
Yeah.
Josh Hartnett was out with a note. Michael Hartnett was out with a note, not Josh Hartnett.
I wish he had a
on
commentary.
on buy the dip, and it looked like investors were doing that.
Yeah.
And now those yields are coming back up. The 10-year back at 4.50, the 20 and the 30 back over 5.
But this is the thing. If we are concentrating back and forth between deficits and trade, it's really hard, Kate, to understand whether this is all good for duration or bad for duration. Because presumably, tariffs back on recession, I want to go buy bonds. But if it's recession plus higher deficits, can you?
Well, and let's take a look at the global picture here too, because all aspects of this kind of also hinge on what international buyers and global investors might do, right? You know, if we are putting pressure on all of our trading partners, if it's a really difficult environment for global asset allocators, and they're asking this question, how much should we own in the US? That's going to have an impact. So it's not just, you know, our own growth prospects or our own policy, but also decisions that global pension funds are making about whether or not they want to own long duration assets, whether or not they want to add incremental risk to U.S. equities, even if they're the highest quality in the world. So there's this other element that we're trying to factor in terms of positioning and sentiment and technicals, all while we're getting, you know, policy headlines one by one by one. This is what I will say. You know, we have been neutral on equities. We prefer to stay in kind of the large cap space when we can. I'd say that's like very close to benchmark. It's very conservative on that front. And I would love to be in a place where I could say, like, let's buy, it's time. I just don't see
That would be great for you and your job, wouldn't it?
It would be. It would be much better than saying, hey, like, hold steady. We don't want to add to risk right now, which everyone gets really tired of hearing me say. But it feels like the prudent thing to do for a, you know, diversified multi-asset fund.
Is there anything, though, that you love? Like, is there any strategy that you wake up and you're excited about? If somebody comes to you and says, Kate, I have to invest this $1 million now, what should I do?
Yeah. I'm an AI lover. I mean, that feels a little bit consensus, maybe a little bit less consensus than it was at the end of 2024. But I believe that any company that doesn't invest in AI and technology and software, training their people, is going to face, you know, an incredible threat to their performance and their competitive standing as we move forward. And so I believe this is going to be like a durable place of spend. And companies that benefit from that spend are going to have more consistent earnings in this period of macro volatility. So, you know, I get a little bit less fussy around valuations of these companies that have incredible tools and platforms, because I just don't think any individual or any company can afford to step away from making these technology investments in this environment.
You know, one trade I've heard, and I got to give Rob Armstrong at FT credit for this, it is the taco trade, which might be what we're seeing now, which is Trump always...
tacos.
Oh, I do love tacos, but Trump always chickens out.
Oh,
The
that's
taco
harsh,
trade.
though. That's harsh.
That's what they're calling it over at the FT, and maybe that's why stocks are down less than 1%. Tacos are delicious too, so fair enough.
Yeah. I guess I'm going to have tacos for dinner tonight because now it's in my head.
There you go. You're welcome for the dinner inspiration. Kate, thank you so much for joining us. Always wonderful to get your thoughts. That is Citi's Kate Moore. All right, let's get a check on some of the movers this morning. So unsurprisingly, I'm going to say the ratio of stocks down to up is definitely going to be decisively down. That's right. We got 458 stocks down. Only 45 of them are up. What's up this morning? You got a little bit of energy, a little bit of healthcare. I mean, United Health is up. That's considerable considering all the pain it's gone through, but those are your safety stocks. Let's go over to the other side. This is organized by points, so the biggest mover. It will not surprise you that Apple is the biggest contributor to the downside after that 25% tariff threat. Tech as a whole is down. Kate Moore just saying she's an AI lover. Maybe this is a great day to buy the dip. Tesla down, Visa, Workday, all of that under pressure. Now, when it comes to the sectors, most of those are on the red too. Actually, all of them are in the red. Just moments ago, utilities was up, but now that's being brought down. So every single one of the sectors, the things that are doing a little bit better, again, are your safety sectors, is utilities. The things to the downside, consumer discretionary. And on that point, Matt, we did hear from some more retailers. We're talking about this. Ross Decker's also flagging weakness, but also under more pain if they are going to face more tariffs, 50%. Yep. That's the threat from President Trump. Okay, coming up, as we've been saying, Trump demands made in America iPhones, a move that analysts say would take at least 5 years. We'll have more on that next on Bloomberg Open Interest.
I'm Alex Rodriguez.
And I'm Jason Kelly.
And we're back with more episodes of our show, The Deal.
The theme of this season, On the Road. We're bringing you more behind-the-scenes conversations with the biggest names in sports, business, and culture, like Melody Hobson.
I started to study women's sports like an 11-year-old studies baseball statistics, and I got dangerous in seeing up arrows.
Susie Wolf.
When you're competing, you're not thinking about any fear or any worries of what could happen.
Josh Harris.
You can't do a good deal with a bad person.
Jay Batt.
At the end of the day, there's never been a better time to be a student athlete.
And more. Stay tuned.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Up-to-the-minute geopolitical news wherever and whenever it happens. I'm Anne Ruhodern in Buenos Aires, Argentina, and this is Bloomberg.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Let's get you some top calls. Some of the analyst action in focus this morning. First up, Canada Goose getting a downgrade to a sell at Williams Trading. The firm says that the parka maker has failed to evolve its brand. It says the company's latest earnings beat is thanks to colder than unusual weather and not any fundamental improvements. I literally saw someone wearing a parka yesterday in New York City, so not surprised on that note. Next up, Deckers getting a downgrade at Telsey Advisory. And let's be honest, a number of other Wall Street firms after their earnings, the maker behind Ugg boots, Hoka running shoes, they had a disappointing fiscal first quarter forecast. They also declined to provide full-year guidance, they said, due to the macro uncertainty, what we've heard from a lot of firms. Finally, Waste Management getting an upgrade at JP Morgan. The firm sees the defense growth sector as attractive given the risk of a U.S. slowdown or inflation pickup because, Matt, no matter what happens, recession or no recession, there's trash that needs to be picked up.
Yes, although a lot of times in New York, we just leave it on the streets for weeks and
Someone
weeks
picks it up.
and weeks. Apple is now valued at less than $3 trillion. Those shares off almost 3% this morning after President Trump threatened 25% tariffs if iPhones are not made in America. Wedbush's Dan Ives has noted that U.S.-made iPhones would be priced above $3,000. Joining us now is Bloomberg Intelligence Senior Technology Analyst Anurag Rana. Anurag, first of all, great to see you. Good morning. Happy Friday. I'm sure you were excited to see this tweet or truth. How likely do you think it is that iPhones will be assembled in the U.S.?
I think they'll have to do something about it, maybe on the highest end, but I don't think after this tweet that Apple can basically say, we're going to, ship all the U.S. phones from India and not worry about any of this stuff. So I think they will have to go out, make peace with the president and tell him that we're going to spend the money on some other high margin items, whether it's chip and other areas. Because to be very frank, assembling a phone in the U.S. is not the best utilization of their resources. You're better off figuring out how to do much more higher end products. So I think they'll have to go out and make a peace with the president and figure out how to, get out of this jam.
Speaking of making peace with the president, Anurag, we saw in Trump 1.0 that some of the most onerous tariffs that would apply to Apple were pulled back because Tim Cook, or Tim Apple, as he was called at the time, had a conversation with President Trump. Do we understand whether those lines of communication are open at this moment?
Now, we'll figure out. I mean, we heard the president saying that there's all these CEOs that were at the Saudi Arabia conference, and, Tim Cook wasn't there. He made a point to point it out. So I'm not sure what's happening behind the doors. But, at this point, he's made it very clear that Apple is not going to, move a lot of the phones from India, or he doesn't want them to, and wants them to make some of them in the U.S. Now, making them in the U.S. is not that easy because you need a massive factory to assemble these levels of phone. If you were to look at just the shipments that come into the U.S. every year, they are north of 60 million units. That is, Apple sells about 220 to 230 million units every year. So that's a very big portion of that particular shipment. So I think what's going to happen is unless they figure out a way to make peace, their market share in the U.S. is going to drop, and lower-end Android phones are bound to gain some market share in the mid-end category because, obviously there is no way you can, sell a very expensive phone in the U.S. and still expect to maintain that high market share.
It comes at a tough time for Apple, Anurag. OpenAI teaming up with Johnny Ive to make something that you have to imagine would be better, cooler, more exciting than even the iPhone. And they really have fallen behind in AI. What do you see as the trajectory of this company's growth story?
See, when you look at it from the product side, they can license these products from other companies. So OpenAI is one of them. And I'm hopeful after the, really awesome demonstration by Gemini or Google or the I/O event, it's possible that they may actually do a deal with them as well in order to get Gemini on the iPhone. So I'm less concerned about they have the distribution system. So yes, they don't have their own LLM that's that good, but they can license that. My bigger worry on Apple on the near term is the App Store fee changes and the money they get from Google for the default search engine. That's a much bigger dollar amount and much bigger, impact to free cash flow than, frankly speaking, AI in the short term.
They get $20 billion a year from Google, is that right?
Something around that. They have not disclosed it, but that's what the reports tell us. And imagine that revenue stream comes with very little to no cost and falls most of it after tax to the bottom line.
Got it. Anurag, thanks so much for joining us. Anurag Rana there of Bloomberg Intelligence talking to us about one of the biggest stocks in the world that is shrinking today. A check on what's going on in the markets. The S&P 500 is down more than 1%, just a bit. Right now at 57.78. Remember, if it falls below 57.70, and I don't put a lot of stock into technicals, but that would mean a drop below the 200 moving day average, and also, my opinion, counts for even less than technical analysis. NASDAQ 100 down 1.4%. The tech stocks are heavier, 20,812, the level there. This is Bloomberg.
Bringing you the latest in tech and AI news whenever and wherever it happens. I'm Tom McKenzie in Paris, and this is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week.
Welcome to Balance of Power.
This is Bloomberg Television.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets. Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
This is Bloomberg Open Interest. I'm Matt Miller. Quick check on stocks here. We are seeing kind of a sea of red when you look at equities. Certainly the indexes are all down 1.1% on the S&P, 1.5% on the NASDAQ. I will say that you do see yields coming down, which means price up on bonds. And that's why you see these two green chiclets here. We're not looking at the kind of drop we had seen earlier. We're seeing the 10-year give up some of its gains in price, meaning the yield isn't down as much. Right now, it's back above 450, and the U.S. 30-year is back above 5. In terms of individual stocks, Tesla taking a hit, even though Dan Ives said it could be worth should be worth $500. Right now, trading at $336. So that's a long way from here. Apple down almost 3%. It's worth less than $3 trillion now. Ross and Deckers pulling their forecast because of tariff uncertainty. You see Amazon down 1.3% and Nike off as well. Those two are getting back together. They're going to sell Nikes on Amazon's website again. We told you that yesterday. But with this tariff news, it's going to be weighing on all of these retailers. Danny?
Yeah, but maybe some of the worst of losses pulling back after Scott Bessent, the Treasury Secretary, speaking to American media, saying, hey, there are a bunch of other deals in the works, and hopefully the EU post from Trump is just something to shake them awake. But regardless, it has been a really rough week for markets. The S&P down 3% for the week, on pace for its worst 5 days since President Trump's tariff announcement on April 2nd. Let's bring in Bloomberg's Jan Patrick Barnett on this. JP, I mean, what a week. Where do we start the push and pull? At first was taxes, now getting hammered by tariffs this morning.
Yeah, absolutely. Let's not forget about the rates play that also played a major role in the middle of the week. So it's definitely clear that the market is getting pulled in different directions. Also, we have a lot of short-term money in play, mechanical flows that are driving the market from time to time, or even from hour to hour at some places, and that explains why the market is so jittery. And I guess everybody knew that it's just a question of time until the next erratic Trump headline or Trump tweet or truth or whatever you want to call it is going around. And I mean, he has never been very fond of the EU during the whole episode of tariffs. So to me, it's not very surprising that he's coming out with this headline this morning. And I guess it's again just his negotiation tactics, if you want to call this. And I'm not even sure if this headline holds until Monday. But for the moment, it is what it is. And tariff uncertainty is still there. Market uncertainty is still there. And that's certainly not good for something if you want to have a quiet weekend.
There will be something new on Monday, for sure, out of the White House. But I wonder how different Monday looks in terms of yields. We're seeing a 10-year yield at 450, JP. We're seeing more than 5% on the 20 and 30-year. This makes financing a lot more expensive for companies as well as countries. How much does this matter to the stock market?
Well, that's an excellent question, and a bit very to answer that. I mean, on the one hand, it's of course, it's a major asset, and it plays a big role in valuation, and especially in the area that everybody loves in the stock market, which is long duration stocks, where you discount the long-term growth. So it plays an important role from a technical perspective. I mean, if it's so important, if we were at 5% or 490 or 510 or whatever, I'm not so sure. But I think the bigger issue for the stock market here is also we are again at the point where we wonder about the deficit in the U.S. And how this is going to be played forward. And this is coming up from time to time to time. And there's never really a solution. We just raise the debt cap, and then we keep on going until there's the next bill or budget coming out, and then we worry again about it. But at some point, it's clear that debt pile is unsustainable. It's a big problem for the financial system, and it speaks to the, I would say, overarching message right now that the U.S. is not in the best place as it used to be, and that's an issue for stocks as well.
Right. Definitely an issue, especially for foreign investors. JP, thanks so much for joining us. Bloomberg's Jan Patrick Barnard out of Frankfurt. Coming up after the break, SEC Commissioner Mark Ueda joins the show to talk about, well, a lot of things, but we're going to focus in on tokenized equities and his team's priorities there. This is Open Interest.
to see over the next 3, 6, 9 months how the tariff discussions play out and what does it mean.
I do factor in some effects of tariffs now on inflation, on prices.
I like the idea of the 10% tariff across the board.
I've spent my entire career focused on fiscal discipline. I don't think these people have the foggiest notion what they're doing. And I think DOGE is doing tremendous damage to government.
Elon Musk is probably the inventor of our age, but who understands that we're in the midst of the most profound convergence among technologies.
When we are facing a once-in-a-generation technological disruption,
we cannot close this retirement gap without private-public partnership. We have to have good policy.
Do you think, Dawn, that the market is correct to be, as of now, pricing in 3 rate cuts in 2025?
I would take the other side of that bet.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
News on the Hour, sponsored by Progressive Insurance.
I'm Deborah Rodriguez. Markets are plunging at the open. The Dow right now down 376, NASDAQ off 255 after President Trump vowed to slap a new round of tariffs on products manufactured overseas. CBS's Stacey Lynn.
The president is threatening a 50% tax on all imports from the European Union beginning June 1st, as well as a 25% tariff on Apple products unless iPhones are made in America.
For Apple in particular, this can be a big deal.
Tech contributor Ian Scher.
Not only because it's one of the most highly valued companies in the world, but also because it primarily relies on foreign manufacturing for its business.
Harvard suing the Trump administration for yanking the university's ability to enroll international students. President Alan Garber calls it unlawful and unwarranted. Correspondent Nikki Batiste.
Homeland Security Secretary Kristi Noem warned yesterday that similar steps could be taken against other universities that don't cooperate. One Jewish Harvard student told me she wants the school to fight these demands, adding she feels like the Trump administration is using Jewish students as pawns.
Foreign students make up more than a quarter of Harvard's enrollment. The suspect in this week's shootings that killed 2 Israeli embassy staffers outside a Jewish museum in Washington, D.C., has been charged with murder. Josh Maxey at the Mishpocha Synagogue tells CBS Mornings.
Sarah fought for peace, and it is just completely ironic that her life and the life of Iran would be taken in such a violent way.
Memorial Day weekend is here, and airlines expect today and Monday to be the busiest at the airports. WTOP's Dan Ronan from Maryland.
The ticket and TSA security checkpoints are operating smoothly. Tim and Brittany Daly are heading from Baltimore to Spokane with their 2 young sons.
We're doing a celebration of life for my grandmother. She passed away last year, but we're getting the whole family together now. They decided on Memorial Day, so here we go.
The TSA says extra security personnel are here at BWI and all of the nation's commercial airports for the holiday weekend, but it's still advising people to get to the airport early. Dan Ronan for CBS News, Baltimore.
Hot weather's not unusual in the United Arab Emirates, but even locals were sweating it out today. high topped 50 degrees centigrade in Abu Dhabi. That's almost 123 Fahrenheit. The National Center of Meteorology says it's the highest temperature ever recorded in May in the UAE since they began recording those temps in 2004. Dow now down 327. This is CBS News. The president hosted big money investors interested in his latest private enterprise last night.
President Trump used his Virginia Golf Club to host a dinner for top investors in one of his meme coin cryptocurrency projects. Businessman Donald Quimby says he bought $2 million worth of Trump coin recently.
We thought this was really the best platform to make a splash and to make some noise.
Critics have labeled it a historic corruption of the presidency. George Washington University professor Jessica Tillipman.
Ethically, this appears to be a president that could be potentially benefiting privately from something that he's doing out in the open.
Steve Kathan, CBS News.
Colorado Rockies lost to the Philadelphia Phillies 2-0 yesterday. The big deal, it drops the Rockies to 8-42 this year. That's the worst record any team has posted through 50 games in MLB's modern era. Deborah Rodriguez, CBS News.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Friday, everybody. We made it to the end of the week. We thought it was going to be a nice light Friday. We're going to Memorial Day weekend. Volume was going to be light, and that did not actually happen. Thank you for the tweet storm. Tariff man is back from President Trump, threatening a 50% tariff on EU goods, 25% tariff on Apple. We're going to break all of that down for you. I'm Alex Steele alongside this guy next to me, John Tucker. We're kind of fighting right now, but we'll get to that later on in the show. We have a good show lined up for you. First of all, Anurag Rana will be joining us from Bloomberg Intelligence, talking about Apple and what that threat means. Ross Matheson will then cover everything from the European side and that 50% tariff threat. Christina Hooper, chief market strategist at Man Group, will talk to us about her outlook for the markets. And then Gautam Mukunda is executive fellow at Yale School of Management, will join us on what is happening with Harvard. Do you know?
I know a lot of students have been caught in the crossfire, and it is a dire situation for them.
Really? And dire for them and for the school. Like, imagine all of a sudden losing, what, 40% of your students and that revenue.
40% of your intellectual capacity, not just for the school, but also for the United States of America.
I know. Well, we're going to break all that down for you. So we got the top stories covered. Let's kick it all off right now with a Bloomberg Business Flash with Charlie Pella.
Hi, thank you very much. Here's what you need to know. Apple shares right now, they're down by 2%. Bitcoin lower now by 1.1%, just below $110,000. Good morning, and this Bloomberg Business Flash is brought to you by IBKR. Will the year-over-year change in the U.S. CPI exceed 2.7% in May of 2025? At IBKR forecast trader, the yes was recently at 23%. Start predicting today at ibkr.com/forecast. Last trading day for this contract is June 19th. Stocks lower across the board. Indeed, global markets rattled by President Trump's threats to impose aggressive tariffs on the European Union and Apple. Stocks getting hit, the dollar sliding toward its lowest since 2023. Bonds joining gains in haven assets. We got you covered all day long here at Bloomberg. Right now, the S&P is down 49, drop there of 0.8%. The Dow down 277 now, down 0.7%. NASDAQ down 211, a drop there of 1.1%. Our Mag 7 index down 1.3% with a 10-year 4.51%, the 2-year 3.96%, the 30-year 5.03%. Gold is surging $51 the ounce, up 1.5%, $33.45 the ounce. Crude up 0.4%, $61.42, and Bitcoin down 1.2%. Bitcoin right now 109,720. Federal Reserve Bank of Chicago President Austin Goolsbee says lower borrowing costs are still possible over the next 10 to 16 months, even as the bar for rate cuts in the near term is, quote, a little higher. And interviewed on CNBC, Goolsbee explained why he is concerned about the impact of tariffs.
In the short run, we got to just wait for the dust to come out of the air. If you throw a lot of dust in the air, everything's always on the table, but I feel like the bar for me is a little higher for action in any direction while we're waiting to get some clarity.
Chicago Fed President Austin Goolsbee interviewed on CNBC. His remarks came after President Trump threatened to impose 50% tariffs on imported goods from the EU and warned of a levy of 25% on Apple phones. Again, Apple shares down 2.3%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, thanks so much, Charlie. Alex Steele here, alongside John Tucker. Paul Sweeney is off today. There's some debate in the studio as to who John Tucker is right now. Is he me or is he Paul?
I am Alex Steele. Alex Steele is Paul Sweeney, and Charlie Pellet is John Tucker.
See, I don't know how I feel about how that was distinguished. So we are figuring that out as we go.
As we do everything.
As we do everything. All right, so market's down by over 1% for tech. A lot of that's Apple. Want to take a look at some of the stocks on the move. Alex Steele alongside John Tucker. We're joined by Bloomberg's Christine Aquino. So let's kick it off with what you're watching. Apple, let's dig more into it.
Yeah, we absolutely have to dig into Apple, Alex. Again, as you mentioned, shares down over 2% at the moment. That's actually pairing some of those pre-market losses. We saw those shares sink as much as 4% before the cash open. And as we all know, the Apple stocks are, of course, at the forefront of the latest tariff threat from President Donald Trump. He threatened a 25% levy on the company if it failed to move iPhone production and manufacturing to the U.S. Now, of course, we have Bloomberg Intelligence analysts crunching the numbers. Is that even possible? What does that mean? And they estimate that the immediate impact is going to be a 300 to 350 basis point cut to their gross margin for fiscal 2026. And we have analysts at Wedbush also estimating that if this happens, then that would translate into iPhone prices of, hold on to your seats, $3,500. $3,500.
Yeah, and essentially building it overseas is a labor arbitrage. Now they got a pass in the first round of tariffs in Trump 1.0. What has changed in the relationship between Donald Trump and Tim Cook? Do we know?
Well, we don't really have reporting on that, John, but yeah, you can imagine there's probably something that has happened or is happening.
He's not building it here.
Yeah.
I mean, end of story, right?
But can they build it here? My point is they can't.
No, absurd, I think is what
one
analyst called it.
We'll just have to pay $3,500 for your iPhones.
Alex would.
Can't. I definitely would not. You know who would? Paul Sweeney. No, I'm just kidding. No, actually, I'm not kidding. Okay, so that's one stock you're watching, which is Apple. We're going to talk about that in just a second with Anurag. Let's go to Deckers. So that was a tough earnings report yesterday.
Very, very tough, Alex. And we're seeing that in the shares today, down more than 21% at the moment. So we know Deckers owns UGG boots, Hoka running shoes, and as you mentioned, they're provided disappointing fiscal first quarter forecast. Now we have a slew of firms this morning cutting their price target for the shares. And we also have management declining to provide full year guidance because of macro uncertainty related to evolving global trade policy. So that's even truer this morning, I'm sure. So yeah, and UGG boots, I guess, are out. I don't really know. I never got into them personally.
John, you? What do you think?
What? Really? That's a legitimate question.
Well, I feel like you know what UGG boots are, right?
Yes, I have paid for them for other members of the family.
Okay. So I don't know. There's some.
You're not an aficionado yourself.
I would.
He has like 2 pairs of shoes. That's. right?
I have 2 pair of shoes,
Yeah, no.
a pair of sneakers, and a pair of dress shoes.
Because he said this. I didn't
That's
make
really
it up.
all
He's
you
actually
need.
said this before. Okay, and let's round it out quickly with Intuit.
Intuit, okay, that is a stock that is gaining this morning. One of the few up more than 8% at the moment. Tax preparation software company, we probably all know it well, reported third quarter results that beat expectations and raised its full year forecast as well. A lot of analysts very excited about their AI-fueled innovation that will be launching in the coming weeks. So that's still, leveraging off of that AI mega trade, right? And so Intuit applying that technology to their tax preparation capabilities, definitely a positive for a lot of people in the market.
All right. Thank you so much. We appreciate it. Christina Aquino joining us. For more conversations like this, subscribe to our new Stock Movers reports. Listen to 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere that you listen. And Market Drivers was brought to you by Commonwealth, supporting more than 2,000 independent financial advisors with a 2-to-1 advisor to staff ratio, small firm attentiveness, big advisor impact. Go to commonwealth.com to learn about their consultative support and technology. All right, let's get to Anurag Rana. He's Bloomberg Intelligence Senior U.S. Technology Analyst. $3,500 for an iPhone? Question mark?
Yeah, I do not know if that's going to be that high, but frankly speaking, it's going to take years for something like this to be built in the U.S. There are no big factories here to assemble these things. The one in India started back in 2017, and it took several years for them to even come up with the first one. So not an easy problem for Tim Cook to solve right now. I'm hoping he's picking up the phone and calling President Trump to see how he can smooth the issues out. Perhaps more spend on higher margin items, on chips and other areas. But putting together an iPhone in the U.S. is going to be one tough task.
Is there a credible scenario for production in the United States? Any credible scenario?
No, there are credible scenarios. It depends on how much cost you want to, incur. If you want to run on a very thin margin, yes, you can do it. The real way to do it is to have robotics take care of it. But that's not, we are not there yet at this point.
The whole point of this is to get workers, jobs created in the U.S.
Yeah, but to think about it, from an assembly point of view, this is not in for anybody's, liking a high margin or a high profile job. You're just assembling phones. I mean, I know what it means from a marketing point of view, but, you're better off spending money on high-end semiconductor chips that are several $100s worth in a phone. A few $100s of labor, from one side to the other does not really add up to the benefit of, anybody, either the US or Apple. What's going to happen is people are going to gravitate more towards Samsung phones because the cost differential is going to be so wide. So it's not easy to go out and do these, what I would call as the lower end consumer electronics products compared to some of the high end, data center stuff or things that have much higher capex involved with them.
So if I'm taking a look at Apple stock, we're off the lows, but we're still down like 2%. Should an investor just completely ignore these headlines at this point?
No. In fact, on the contrary, this is no longer about U.S. and China. This is concerning because this is a direct, you could say, direction towards Apple and say, well, you are not doing enough. Let me see what you're going to do now. So don't go by that 25% because if Apple doesn't go out and fix this problem, this rate could go up even higher. So it's more so directed towards one company, which is very unusual for us to see, frankly.
What has changed, do we know, in the relationship between Donald Trump and Tim Cook? Because as I said before, they kind of got a pass the last time around.
Yeah, I'm not privy to those discussions, frankly. And, one of the things I remember, we just heard that he did complain in one of his speeches that Tim Cook wasn't around with him when he was, visiting the Middle East. So I do not know what's happened behind the scenes, but definitely not the best time for Apple in terms of their government relationships. So that's why I'm saying I'm hoping that they, pick up the phone, figure out whatever the deal is, they make it, they spend the extra money and take care of whatever the big, lingering issues are.
So now no one's been able to answer your question. So that leads me to believe that you need to go research this, Tucker. Nobody knows what has changed between Tim Cook and President Trump.
Again, I was filling it for you.
He's just going to rub salt in this wound. So Anurag, just, for you to know, Paul's out today. So John Tucker comes in and says, I'm going to be you. Alex, you're Paul. You do all the work, and I just sit here, and I am continually offended by
We really
this.
started off on the wrong foot.
We really did. Anurag, see, he's laughing. He knows that's not true. Anurag, I appreciate you. Anurag Rana, Bloomberg Intelligence Senior Technology Analyst, joining us. Apple off the lows of the
We
session.
don't have to air our dirty
Down by
laundry
2%.
in public.
You brought it. It's here. Mom and Dad are fighting on radio. Okay, coming up on the program, we are going to break down the other side of the Trump tariff tumult today, and that comes on the side of Europe. A potential 50% increase on tariffs in Europe doesn't seem to like the pace of negotiations. That was sort of the comment behind President Trump. Roz Matheson, Bloomberg News Director for Europe, Middle East, and Africa, will join us. Then we'll get the market action with Christina Hooper, Chief Market Strategist at the Man Group. So as a market participant, what do you do, particularly when that curve just got really steep this week with that 30-year around 5%? This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 10:21 on Wall Street. We do check markets all day long here at Bloomberg. Stocks lower. Apple now down 2.5%. This Bloomberg Business Flash is brought to you by Oracle. Attention growing businesses. Oracle is offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure for new U.S. customers with minimum financial commitment. See if your company qualifies at oracle.com/Bloomberg. Stocks lower across the board. All about tariffs today. Global markets rattled by President Trump's threats to impose aggressive tariffs on the European Union, and Apple stocks getting hit, the dollar sliding toward its lowest since 2023, bonds joining gains in haven assets, equities dropping across the board. We've got more on the markets coming up for you in just a moment, but right now the S&P's down 54, drop there of 0.9%. The Dow down 325, decline there of 0.8%. NASDAQ down 1.1%, and again Apple lower by 2.3%. 10-year 4.50%, but the 2-year currently yielding 3.95%, the 30-year 5.03%. Gold is surging $58 the ounce, up 1.8%, now at $33.52. West Texas Intermediate crude $61.64 a barrel, up 0.7%, and Bitcoin now down 1.2%, just below $110,000. Trump Media and Technology Group, owned by Donald Trump, plans to sell investment funds tied to his agenda, including ETFs and separately managed accounts under the Truth.fi banner. Shares of DJT, little change right now, down less than 0.1%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thanks a lot. Alex Steele here alongside John Tucker. This is Bloomberg Intelligence Radio. We bring you all the top news in business, economics, and finance. You can check us out on YouTube. You can also check us out on all your over-the-top counter places where you get your news, like Roku and smart TVs. Definitely check us out there as well. So the tariff Trump man definitely came into effect here. President Trump rattled overall markets with a new tariff threat on European goods at 50% now, not liking the pace of these tariff negotiations. Roz Matheson, Bloomberg News Director in Europe for the Middle East and Africa, joins us now. Roz, how seriously is Europe taking this?
Well, so far the Commission is saying nothing, and that's because they're probably waiting for this conversation that's supposed to be happening today between their chief negotiator for the EU, Mauro Sefcovic, and Jamieson Greer, his US counterpart. So they're laying very low before that call. But what we can sense already is the idea that they see this as a negotiating tactic. And indeed, the US Treasury Secretary Scott Bessent seemed to indicate that a short time ago when he said he hopes it, quotes, light a fire under the EU, and it seems to just be going into that call a sense of frustration from the US at the pace of the negotiations rather than they are intending at this minute to impose a 50% tariff. And so they're seeing it as part of the realm of the negotiations and the tactics from the US at this point, even though you did see obviously that market reaction. We didn't see a massive move, for example, in the euro, again pointing to the idea that in the market as well, people are interpreting this as part of the cut and thrust of being negotiating on trade. And so we have to really see at this point what happens from that phone call later today.
You saw the social media post from the president. Does Donald Trump have any legitimate gripes when it comes to the EU?
Well, he says he does, and I guess the frustration on the US part is that the EU is just a much bigger economic entity to deal with than, say, getting a trade framework agreement with a country like the UK, where I am. And so these are much more complicated arrangements with a collection of companies, the EU, versus one individual country, and a lot more economic clout on the EU side, arguably, as well. And the EU has its own lines in the sand, be it around agriculture, cars, and so on. And so these were always going to be much more fraught negotiations.
What did the EU propose that President Trump thought was not good enough?
Well, they came back with a counter proposal to the US proposal, to the previous proposal. There's been a bunch of counter proposals, but this is about addressing some of the issues around environmental standards, labor standards, and a framework the EU was setting out to move towards zero tariffs on a lot of goods, aside from things that are seen as very essential, including around agriculture. And obviously that proposal has gone to the US. The US is not happy with it. They're coming back for a further conversation. But again, the message is that Donald Trump obviously wanted these conversations to be moving a lot faster than the reality is the EU was probably going to move. And so now they're leaning heavily on the idea of, Donald Trump saying, I would give you a number, and here is the number. It's 50% if you don't comply. Again, the question is that the new 10%, or is that on top of what we already know? It seems to be it would be a flat rate either way. But again, the reality is the US is negotiating at this point with a much bigger economic entity in a much more complicated fashion. So these conversations are always going to take time. And even then, you're just looking at getting a framework, not a lot of the nuts and bolts of a full-throated trade agreement.
Roz, thanks very much. We appreciate it. Roz Matheson, the Bloomberg News Director for Europe, the Middle East, and Africa. Well, what next for investors? Still trying to figure out exactly what this trade regime is, the tariff regime. Christina Hooper, our next guest, the Chief Market Strategist at the Man Group. Do you change your investment strategy now with these new threats?
Well, I think we have to look in terms of all the threats right now, because it's not just tariffs, right? We also have increased concerns around the creditworthiness of the U.S., just how large our fiscal deficits are going to be. All of this is likely to conspire to drive up yields on the long end, apply downward pressure on U.S. stocks, and I think, again, reinforces the case for being very well diversified, making sure one has adequate exposure outside the U.S., especially in areas like Europe, the U.K., Asia, but also alternative investments, right? And we want to have lower correlating asset classes in our portfolio because there can be some really significant swoons in markets. The U.S. tariffs are going to impact other regions as well. So it's all about thinking holistically with one's portfolio and trying to contain volatility and look for opportunities where they present themselves.
So that's where the question marks for the 30-year come in for me, because if we almost touch cycle highs for this cycle, and if we break through that, then we're at a place we haven't seen since 2007, which is a very different regime change. So how can persistently higher 30-year yields affect how you should be diversifying?
Well, I think it reminds us and likely continues to amplify downward pressure on U.S. stocks. So I think what it drives us to is looking for alternatives, and that is European equities, UK equities, where valuations are lower. There's arguably less vulnerability with lower valuations and higher yields. That's what we've seen historically in disappointing times, in downturns. But also beyond that, looking for other areas that generate significant yields. There are many other places to go. In fact, credit is one place to go in this kind of world. To me, this is just a reminder that we can't continue to follow more traditional paths in terms of a 60-40 allocation, in terms of being overweight U.S., because that really has been what most U.S. investors have done.
For a company with a component of leverage or longer dated debt, how's the landscape changed here?
So I think the landscape is changing as we speak, right? And we don't know exactly where we end up. First of all, we don't know exactly where this budget bill goes. We don't know if what the Senate comes back with is going to be markedly different. We don't know if it's going to accelerate the growth in deficits the way the House budget will. So it remains to be seen where the U.S. ends up. Moody's, of course, had warned about this downgrade back in November of 23. And so it took them a while to actually do the downgrade. And of course, it only is adding to what has already been downgraded by S&P and Fitch. So I think we have to recognize that this is just a work in progress. And maybe this is a reminder to the Senate, to policymakers in general, that we're going to have to be more fiscally prudent going forward. We've had attempts at that. There was a success in the late 1990s. So we could be at a crossroads right now where we could see the U.S. perhaps get religion and go in a different direction, follow the path of the late 1990s and get far more fiscally prudent. So it doesn't have to be that 30-year Treasury yields continue to go up.
So I guess that's your point, though, that who knows if that's going to happen? That feels like a coin flip. But to your point, that's why you need to be diversified, because you just don't know. So you need to be prepared for sort of all circumstances. What's the role then of alternative assets within that?
Providing lower correlating components of one's portfolio, so that if you have stocks doing poorly and traditional fixed income doing poorly, you have treasuries in your portfolio are doing poorly, this is an area where you could see a difference in terms of performance.
Is that gold?
It's a variety of different asset classes. It's gold, it's real estate, it's private credit. There's so many different areas within the alt space. It's hedge funds. There are so many opportunities to find components of the market that behave differently than the most traditional asset classes.
First quarter was not bad. What, 10% earnings? Were you looking at the earnings, or did you care about that, or more like the guidance and the commentary, or the lack of guidance?
I always focus more on the guidance, and the lack of guidance was stunning, and a reminder to us of the kind of environment we're in. Tariffs are a real concern because they create economic policy uncertainty. And I think that is the much bigger issue right now, because what we're seeing today are tariff threats. They could just be a negotiating tool, but they give companies pause, and they have a chilling effect typically on business investment and hiring.
And when do we see that chilling effect? Second quarter, third quarter, in terms of layoffs, lack of investment? When did we, the consumers, start to see this?
So I think we're going to start to slowly see that happen over the second and third quarter and beyond if we continue to have this level of economic policy uncertainty. I think having that lack of visibility for so many companies just leads them in this direction. And if we go through the ISM surveys, what you see over and over again is references to uncertainty and how it really has become quite heightened this year.
What's so weird is that some companies talk about uncertainty like Deckers, and then other companies say, no, we're standing by our guidance. And then other companies are like, here's my fan chart of like all the different scenarios. It's really odd.
Well, I wonder if like some are using it as an excuse, like, you know, companies do, like the
with weather. But weather could be real, and also it could help explain. It could be both. Both things could be true.
And it depends on the type of company. But, you know, I was talking to one of my industry contacts who is a department store buyer, and she said, you know, with 30% tariffs on Chinese goods, and the vast majority of my goods are Chinese, I absolutely do not know how to price them.
Right. So that's real.
Yes, and that container ship costs are going up. And we have to factor that into. So it could very well be not that dissimilar to the kind of pandemic environment we saw, where it was just container ship prices were going up, and there was a real lack of understanding of how we can price this for profitability.
What department store did she buy for?
Well, I can't say.
Wow, God, I was looking for that in there. That sounds fun. Okay, thanks a lot, Christina Hooper, Chief Market Strategist at the Man Group. I'm going to go shopping with Christina after this.
Oh, yeah.
We're going to do that. All right, coming up.
Don't leave me, though.
No, you're done. You're going to be Paul and Alex. So I don't know what that means for you. All right, coming up, Gautam Mukunda is Executive Fellow at Yale School of Management.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
Check markets all day long here at Bloomberg with the Dow, the S&P, NASDAQ. They're all in the red right now. Concerns about tariffs. Apple shares moving lower by 2.4%. We've got the S&P down 46. That is a drop right now of just about 0.8%. Dow Industrials down 254. Decline right now of 0.6%. While the NASDAQ Composite Index is lower now by 178 points. For NASDAQ, a decline of just about 0.9%. Our Mag 7 index down 1.1%. 10-year 4.51%. The 2-year 3.96%. Gold up 1.8%. 33.52 the ounce. And West Texas Intermediate crude up 0.6%. 61.59 a barrel on WTI. Bitcoin now at 109,760. Bitcoin lower today by just about 1.2%. Global markets rattled by President Trump's threats to impose aggressive tariffs on the European Union and Apple. Apple, as we mentioned, moving lower. Christina Hooper is with the Man Group, and she was a guest moments ago right here on Bloomberg Intelligence.
We also have increased concerns around the creditworthiness of the U.S., just how large our fiscal deficits are going to be. All of this is likely to conspire to drive up yields on the long end, apply downward pressure on U.S. stocks.
Christina Hooper of the Man Group interviewed right here on Bloomberg Intelligence. So again, the Dow, the S&P, NASDAQ all lower. S&P down 0.8%. The discount retailer Ross Stores now plunging by 14.5%. It is pulling its full-year profit outlook because of heightened uncertainty caused by tariffs. Recapping, Apple shares lower, down 2.5%. For on-demand news 24 hours a day, subscribe to Bloomberg News now wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thanks a lot. Really appreciate it. Alex Steele here alongside John Tucker. Paul Sweeney is off today. This is Bloomberg Intelligence Radio. We bring you all the top news in business, economics, and finance. We are broadcasting to you live from our Interactive Broker studio right here in Midtown Manhattan. Check us out on Roku, on our smart TV, our originals content, as well as YouTube.com. The stunning headline, I sound like Tom Keene, but the stunning headline from yesterday that really truly was a jaw dropper all across the newsroom was Harvard University in its latest conflict with President Trump. Harvard now suing the Trump administration over the Trump administration's decision to block the school from enrolling international students, and that affects 27% of the student body. Gautam Mukunda is executive fellow at Yale School of Management. You just put this into context of what this could mean for a school like Harvard that not only relies on the brain power of the 27% of the student body, but also the money of the 27% of that student body.
So this is potentially very damaging for Harvard, which of course relies not just on the money and the brain, right? These are money and brain power. So these are some of the best students in the world. But there will be a Harvard for a long time after this. Universities are incredibly resilient. Oxford, if you go to Oxford and Cambridge, you will see niches in the walls that are empty. And if you look into the back of the niche, you see shattered remnants of sculptures because Oliver Cromwell's soldiers stormed the universities and shattered the images. Universities survive lots of things. The damage here is not to Harvard, it is to the United States. Just back up for a second and think about this. Imagine that the Chinese government decided to attack an American asset that generated tens to hundreds of billions of dollars in economic value every year. That was the single most important institution in securing American leadership in science and technology. And that also took in the next generation of global leaders, exposed them to the best of the United States, and indoctrinated them in American values, and then sent them home. If the Chinese government decided to attack an asset of that value, we would expect the United States government to go to war to defend it. And instead, it is the United States government that is doing it to us, to itself.
And beyond the economic contribution of these students, there are other components too. This is sort of like, I mean, would you think that it's sort of like the United States shooting itself in the foot?
The United States shooting itself in the foot would be kind compared to that. This is the United States shooting itself in the stomach. Let's put this in perspective. just recently, Nature identified the 10 top research universities in the world. So the 10 universities in the world that contribute the most to science and technology. Only 2 of those 10 were American. The other 8 were Chinese. 8th was MIT, and 1st was Harvard. There is no way to be globally competitive without leadership in science and technology, and the Trump administration is attacking the institution of the United States that is most successful at doing that.
So how does this then play out? Clearly, this will be tied up in the courts forever, and there was a stay from a California judge overnight. But if I'm an international student, why would I even take the risk at this point? Like, the brain drain can start now.
Yeah, I mean, so this is clearly lawless by the administration. It is clearly pretextual. So in Kristi Noem's letter to the Harvard, there is not a claim of any laws being violated. It is simply a bunch of demands. And I note that in Secretary DeVos's letter to Harvard explaining why they were taking earlier actions, anti-Semitism, which is supposedly the reason all of this was done, was not even mentioned, right? This is clearly pretextual. This is not to say that Harvard hasn't made mistakes. Of course it has. It's not to say that Harvard hasn't handled issues badly. Of course it has, but none of this is about that, right? And so from the perspective of not just students, but also top-tier researchers, right, who are dependent heavily on federal funding, they're going to be thinking about leading. And here's the irony of all ironies. Hong Kong Technology has already announced that they will accept students and researchers who are refugees from Harvard on favorable terms. The Trump administration is taking the best minds in the world and trying to make them flee to China.
Is there time for them to even transfer, as Kristi Noem or whomever in the administration said they should do?
You know, it depends on the person. It depends on the student. But there are people who are devastated right now. I'm getting emails from former students who are in tears, who don't know what's going to happen to them. And surely the cruelty is part of the point. I mean, let's be clear. This is not, Kristi Noem said this herself. This is not about Harvard. This is about an attempt by the administration to break American higher education to its will, right? It is trying to seize control of American universities and get them to become organs of indoctrination. And that's not me claiming it. That is literally what Kristi Noem has stated in her statements, right? So yeah, this is going to go a lot beyond Harvard. And you know, you may leave Harvard and find out that it chases you to wherever you go next too.
How does this affect, this comes from our producer in the control room, how does this affect those that are graduating next week? I mean, if you're an overseas student, like, do you wind up getting that degree?
I mean, my guess is that Harvard will be able to get a stay in place for the next week, but no one knows that the cruelty and the chaos this is imposing is not accidental. It is the point. They are trying to inflict as much harm as on everybody because it is an object lesson for everyone else, right? Harvard has more wealth, more power, and more institutional strength than almost any other sort of organization in America. I mean, this side of Bloomberg itself, Harvard may have more independence from the federal government than anyone else. If they can break Harvard, then they are sending a sign that they can do it to anybody. And that is the message that this is trying to convey.
Not to mention the network of pretty powerful alum. Where do they come in on this, and how can they help?
Mm-hmm.
So the alums are sort of consistently, not all of them, to a huge amount rallying. I'll tell you something that I said that I've heard also back from many other people. You know, I first got tied to Harvard in 1997 when I was admitted as an undergraduate. And, you know, I was there as a student. I was there as a faculty member. I'm at Yale now. So, you know, some mixed feelings about this because of that. But I've often been proud of being associated with Harvard because it said something about, you know, about me, that they admitted me or whatever. But I've often been skeptical about Harvard because it seemed focused on, you know, maybe money or ambition over ideals. There are always things to criticize there. This is the first time in my life that I have been proud of Harvard, right? I have been proud of the fact that the university is clearly taking a step up and saying, we are the front line of defense of American democracy, and we will hold the line. And I cannot tell you how many alums have said to me, they have never felt this good about Harvard as they have at this moment.
Wow. All right. Well, we really appreciate that. Thank you for joining us. Gautam Mukunda, Executive Fellow at Yale School of Management, joining us on the latest news from Harvard and the Trump administration and where we go next.
Yeah, exactly. Columbia has come under pressure, and many of the Ivy League schools.
Well, Columbia, in essence, bowed to some demands, though, or gave in. I don't know what the right word is, but gave in to some of those demands from the Trump administration versus Harvard that did not. So we'll see. All right. Well, there you go. All right. Coming up, we're going to break down the commodity markets. If there's uncertainty, how high can gold actually go? Mike McGlone, Bloomberg Intelligence, joins us in studio. This is Bloomberg.
Listening to Bloomberg Intelligence with Paul Sweeney and Alex Steele on Bloomberg Radio.
And I'm John Tucker, along with Alex Steele, who's pretty much the boss around here. This is
remember that.
Bloomberg Intelligence. S&P 500 right now, just a quick update, 56 points higher. That is 56 points lower. That is down 1% with all the news that's happening on this Friday before the long holiday weekend. So what do you get when you combine gold and Bitcoin? You get lots of questions for our next guests. Mike McGlone, Bloomberg Intelligence Senior Commodity Strategist, joining us here in studio. His usual haunt is Miami, so we have the worst weather in the world for you this weekend, Mike. Give us an idea of what the correlation is between gold and Bitcoin.
It's a unique ratio. I like looking at gold in terms of how many ounces per Bitcoin. Right now it's about 32, 33. The significance of that, John, is it was first traded that level in 2021. And it hasn't gone up much more. It got up to 40, it's dropped to 25, and here we're stuck. It's not a good sign for this highly speculative crypto asset that you've mentioned. I hear people talk about at the barbershop.
Yeah, the barbershop, that's like the number one topic among the people.
Are you serious?
And this, I'm not putting them down. This is the number one topic among the people who can least afford to take a big hit.
I mean,
what does
some
that tell
barbershops,
you?
though, probably are very successful. Also, barbershops, what are you guys, from the 40s?
No, well, yes.
Aren't they called, like,
Well, he doesn't go to
haircutting
a
I haven't been
places?
to one in decades. You keep looking at my hair and not on the radio. But so I earned a reputation in 2022 as a notable bear in oil, and I had to wear that. You have to be thrown down on the mat for a while. I'm willing to wear it in Bitcoin. I'm becoming a notable bear in Bitcoin. To me, we're at the speculative, excessive stage. I remember seeing in 2017. All the questions I get now are similar to that. The excess of leverage I'm seeing in the space is getting significant. And now also, if you look at the last 16 quarters, that's the 4-year cycle it works on. It's the highest correlation to the S&P 500 versus beta at 0.7 in almost 20 years. And then you look at Bitcoin's correlation to gold and gold's correlation to the stock market, it's almost zero. So I stick with this year. My call is sticking with what I see from Anna Wong and Gina Martin Adams. There's more likely to have a lower stock market. That's bad for Bitcoin. Gold's been outperforming. I expect to continue outperforming. It got a little expensive, and that's why that Bitcoin gold ratio is really important to me. I think it's more likely to go down as gold continues to beat. And today's a good example. What we're seeing now, the stock market goes down, you see selling in Bitcoin and buying in gold. So the way I see it, stock market has to go up or gold's going to continue to beat.
So what about the idea that once we get past the difficulty with trade and we get to the tax cuts and things get a little bit better and the Fed starts to cut, that gold will sort of top out here and move lower? Like it's not even a bear case, but what's the non-bull case for gold?
So that's the good one. I think the prerequisite for gold to come back, to drop its almost 30% gain this year, the stock market has to go up. And you're seeing what happened today. It's rolling over. But why is it rolling over? Why is this Trump administration emboldened to continue his target on tariffs? Because the stock market went up. And what's the number one force to curtail that? What happened when we added the 90 days? It was when the stock market was low. So see that cat and mouse game? I think we're in that stage now. Remember TARP, when they first denied it, the stock market crashed and then they accepted it? We're in that stage now that I think the administration is going to be more emboldened to do tariffs when the stock market's strong and only push back when the stock market pushes against. And then we have this issue with the stock market at 2 times GDP. It's only really 2 examples in history. 1989 in Japan and 1929 in the U.S. So to me, when you get to this stage, all that matters is the stock market, and gold's figuring it out.
Can I move on to our next commodity? What's going on with oil?
You're going to be able to, by this time next year, John, average gallon of gasoline in this country is like
It's 310.
320.
It's 310. I actually looked this morning.
I think it's going to be down to 2 next year.
317 actually.
No,
Doesn't
very
matter.
close.
Okay.
But it's already down, so you can't really compare it. You got to compare it to this time last year because it's seasonal. This is driving season kicking in. There's not a lot of excessive demand. We have actually a lot of ethanol in the space, but I think it's going to drop down to 2. First of all, that's what it's done for the last 20 years. It usually drops. The key prerequisite for that is crude oil drop until 40, still my base case. And the number one thing to make that all happen is to say the stock market gives back 20% of its 100% gain since the end of 2019. That's what I think is all kicking that way.
The reason for it, are they good reasons or bad reasons?
Well, superabundance, low oil prices are good, but I think people are going to misunderstand. The good reason is we had 100% rally in U.S. stock market since 2019. That's great. When it drops back 20% at some point, people are not going to look at it like it's good. So that to me is what's happening. We're at that stage, and that's why I have to say cryptocurrencies are the leading part of all that. And even with the stock market going up, crude oil still ticking down. And what's the vested interest of this administration is lower energy prices. So I think they're going to get them.
But you know what the cure for low oil prices are?
You got
Higher
it.
prices. So if we hit your 40, we're going to see a big price spike at the end of the day, aren't we?
So that's but see, remember the part of the cycle, we're still on the back end of the spike to 2022. We're still pushing lower, and you can see all the trends in supply and demand are unfavorable. Now we're cutting back a little bit in the space you know very well, Alex, is shale supply, but it takes lower prices. So I think it's going to have to get below 40. It's a question of how long it stays there. And a key trigger for that, let's just say we have a 10% correction in the stock market this year. That's severe deflation from the inflation. Crude oil's kind of leading the way.
Yeah, you know, we already had that. We had that 10% correction, actually 20% in the stock market.
So that's a key thing. That's why I pointed out today. My headline would say, if beta rolls over, it's all that matters, and it looks like beta's rolling over.
All right, Mike, really go. Are you in the city next week, or are you
No.
back to Miami? You're like,
my
check
tan's
this later.
fading. It's really bad.
It's understandable. Well, Mike,
He's
it's good to
gotta go
see you.
recharge.
He has to recharge. Mike McGlone, Bloomberg Intelligence Senior Commodity Strategist. Good to see you. Okay, for our listeners in the U.S., here is a reminder. You can listen to us via satellite radio on Sirius XM Channel 121, everyone. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM channel 121 is presented by Oracle. Stay tuned for the latest market news and industry research. The next hour, Bloomberg Intelligence starts right now, and you're looking at an equity market trading a little bit heavy here on this Friday. Volume still light. The Nasdaq is off by 1.2%. The S&P, though, off by about 1 percentage point. This is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Friday, everybody. We made it to the end of the week, and we're not done yet. Heavy news flow on this Friday from President Trump, and we have a great lineup for you. We're going to be speaking to Chile's finance minister in just moments in town for a Chile Day event, but we're going to get deeper also into what it means for copper production and trade.
Chilean ministers in town for the Chile event?
Chile Day event.
Chilean.
Yeah, Chile Day event.
Okay.
Anywho, all right. We also have a great interview lined up for you with Scott Bessent. David Weston will be talking to him, the Treasury Secretary, coming up at the half-hour mark.
That actually is must listen, considering the headlines that we got today.
First of all, the whole show is must listen.
Well,
but yes, definitely want to tune in for Scott Bessent. Also, we're going to be talking about munis. Interestingly, when you have that Harvard news from the Trump administration about basically saying international students can't come anymore, what does that wind up meaning then for the muni market? Like, where does Harvard get money now?
Well, you would hope from their alum.
Endowment and their alum, but still, I mean, that could potentially be a big hit. So we're going to talk about all of that within the next hour. But let's kick it all off for you with the Bloomberg Business Flash. And for that, we go to Charlie Pellet.
Hi, thank you very much indeed. Ahead of a long holiday weekend, we are looking at a lot of selling for the Dow, the S&P, NASDAQ, very much in the red. All about tariffs. Apple right now trading lower by 2.6%. We'll tell you more about that in a moment. S&P down 55, 57.87 where we stand. We've got the S&P lower by just about 1% now. The Dow down 347, decline there of 0.8%. NASDAQ down 1.1%. The NASDAQ 100 index lower by 1.1% as well. Russell 2000 index down 0.8%. The Bloomberg Mag 7 index down 1.4%. Apple bears repeating, down now by 2.7%. The 10-year 4.51%. The 2-year 3.96%. Spot gold up $65 the ounce, up 2%. 33.59 the ounce, and West Texas Intermediate crude up 0.5%, 61.53 a barrel on WTI. Bitcoin now down 1.2%, just below $110,000. As for the Federal Reserve and the bond market, Emily Rowland is co-chief investment strategist at JH Investments. She was a guest this morning on Bloomberg Surveillance.
We also have increased concerns around the creditworthiness of the U.S., just how large our fiscal deficits are going to be. All of this is likely to conspire to drive up yields on the long end, apply downward pressure on U.S. stocks.
And you can hear more of the conversation with Emily Rowland on the Surveillance podcast. You can download it wherever you get your podcasts. President Trump is threatening Apple with a tariff of at least 25% if the tech company does not manufacture their phones in the United States. Apple lower now by 2.5%. Stay with Bloomberg for the very latest on the tariff story. We got you covered on markets, and again, ahead of a long holiday weekend. For on-demand news 24 hours a day, subscribe to Bloomberg News now wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, thanks so much, Charlie Pellet. Appreciate that. Alex Steele here alongside with John Tucker. Let's take a look at some of the stocks in the move today. We're joined by Bloomberg's Christine Aquino. All right, let's kick it off with Ross Stores.
Yeah, Ross Stores, Alex, that's not doing well today, down more than 14%, and that's after we got the second quarter earnings per share forecast. That missed the average analyst estimate that we saw at Bloomberg. The company also withdrew its full year sales and earnings guidance, citing all this uncertainty that we're seeing in
what
the
does Ross Stores sell? I've never been in
stuff. Discount retailer.
Well, I know stuff, but
Clothes,
like what kind
shoes?
of stuff?
That kind of stuff.
Remember Ross
like
Dress
Kohl's.
for Less?
Okay.
Dress for less. Yeah.
You could totally do a Ross Stores.
What are you saying?
Meaning that,
low
like,
end?
TJ Maxx is too much for you. Like, you definitely couldn't manage that, but you could definitely do a Ross Stores.
John
And
Tucker
Kohl's.
for Ross Stores. Yeah.
We'll do a trip.
But of course, it's margin pressure, really. That is what investors are worried about. The company already called out about 100 basis points of margin pressure for the second quarter. And you can imagine that the increased uncertainty following today's round of tariff threats really just adds to that pressure.
All right, let's go to Nike here. So the stock was up a lot yesterday because it's going to start selling its stuff on Amazon again, but now is it getting taken out again by Deckers? Is that what we're seeing?
Well, probably a little bit of follow through from that, Alex, but also probably a reaction to what we've seen, right? The escalation in tariff threats once again. That stock is down more than 2% today because, its exposure to this global trade tension really can't be denied. In 2024, 50% of its shoes and 28% of its apparel came from factories in Vietnam. 16% came from China, and in Cambodia was responsible for making 15%. All three of those countries are exposed to tariff threats at the moment. And so Bloomberg Intelligence actually, in their latest tariff tracker, citing Nike as one of the most affected companies by the new tariff landscape.
And finally, Seagate Technologies, is it?
Seagate, that's right. So it's, we know it's a maker of computer hardware and storage. It had an upbeat investor day event. It's up 2% or nearly 2%, 1.8 now, pairing some of those earlier gains, but still in the green. And we saw the company setting its targets for the period through fiscal 2028. It's seeing 40% adjusted gross margin with further expansion. It's also planning to buy back up to $5 billion of shares. And so now we're seeing Morgan Stanley raising its price target for the company, $140 up from $99. So quite a hefty upgrade there.
Hi, Christine. Bloomberg's Christine Aquino with some of the stocks on the move. And for more conversations like this, subscribe to our new Stock Movers Reports. Listen for 5-minute radio reports on the biggest winners and losers in the stock market. You can subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere you listen. Well, President Trump threatening a 50% tariff on the European Union, and that starts like June 1st, citing stalled trade talks. Let's take a deeper dive into this. Kevin Whitelaw joins us in studio on a Friday before a big holiday weekend, Bloomberg managing editor. Just a threat, negotiating tactic. What's your read on this?
At this point, I think everyone's still trying to figure this out. But yeah, I think the ultimate, point here is probably a negotiating tactic until it's not. We have seen over and over, Trump has been very frustrated with the European Union. This has been a constant theme for a number of months now. The ultimate problem is the things he's asking for are things that the European Union can't really give him. And so it's really not clear at some point.
Because the European Union, the way that they're fragmented is difficult, or?
Well, it's more like, the president has decided that the value-added tax, the VAT tax, is a non-tariff trade barrier. But it's a tax and it's a revenue raiser, and it's absolutely integral to the way countries, basically all 27 member states do their budgets. That's not going anywhere. They've made it very clear they don't see it as a trade barrier. Everyone pays it. It's not about exports or imports. And so their view is that's not negotiable. And obviously that's been something that Trump has kept coming back to over and over and over. So until you get to the place where one of them changes the way they're looking at that, it's not clear how that gets solved. So at some point, there's going to have to be a decision in the White House. What are they actually looking for that the European Union might be able to give them, or do they really want to go on a full trade war with one of their biggest trading partners?
What is the